could run something else, but then you're just like everybody else are doing one thing and you live in your own tiny world and nobody cares. Like, oh, you made $1 million, right? You just added money to yourself. But yes, only in your world. Nobody else accepts it. It's not in the consensus. So this is kind of like the idea of blockchain to smart contract. So instead of matching engines, etc., people work with these smart contracts. So if we said earlier, Uniswap, I think it's the largest decentralized exchange. It's I think the best example. It's that AMM thing that we mentioned earlier. Okay, so basically, let's say the price of ETH is $1,000. It's not, but it's easier to kind of. And there is liquidity there. Okay, so there are 1,000 ETH and $1 million, and that's the current market. Now you think this is too low. It should be higher than that. Okay, so you go to the Uniswap smart contract, and you say, I would like to buy $100 worth of Ethereum. So you increase the amount of US dollars there, USDC, and you get back some amount of ETH, and the price is kind of like based on this new ratio between them. But the point I'm trying to make here, no single entity has control over it. This is like a program that does it, but that's being run by everyone. No single entity can control it and push it in one way or another. So when you take stuff or primitives or ideas or concept from CeFi to DeFi, that's the first change that happened. The second change that happened is that you no longer have order flows and price feeds coming from that centralized point. Instead, you have a network, right? So if I want to buy Ethereum, buy ETH, as I mentioned, I create a transaction and say, well, here I have $100. I want to speak with this smart contract and make that action, and I signed it. And you just kind of propagate to the network. And then after a while, some validator or miner creates a new block, and then we say it executed. It was added to the chain. Okay. So instead of order flows and price feeds, you have transactions propagating around and blocks propagating around. So that's the second component, which is different as we move. And the third one, and the most critical from my perspective, is that we just moved from a point-to-point model to a peer-to-peer model. So if you're a competitive market maker or a trader, then in traditional finance, you need to be connected or co-located with Chicago, New York, London, Amsterdam, Japan, Hong Kong, Shanghai, blanking on 3 others. But basically, the major exchanges around the world, this is who you need to speak with. And in the DeFi setup, you need to be connected with the entire network. Okay, if you want to be competitive, critical information could come from anywhere, right? So a transaction coming from this direction, you want to say somebody is selling ETH, somebody is buying ETH, somebody got liquidated, somebody put a new position, etc. So all this is happening, and for you to be a competitive actor, you need to see all these. And this is kind of like the framing of DeFi. This is how you move from CeFi to DeFi. These are the changes. Now, going back to your question, well, I'm not, and again, me personally, I'm not a trader. Like, I trade a bit, etc. But I'm, if big trading firms has like the traders and they have the tech guys supporting them, it's kind of like, oh, let me build you this tool and that tool. I'm that guy. Okay, I'm the tech guy who can help. And so when I participate in DeFi, a lot of the time I run a company. I have really better stuff to do, which is more valuable for me and the world than being the trader. I'm not actually that good at it. So like let somebody who's, this is what he does, do that. But it does open at least a few interesting opportunities. One of them is, as we mentioned, so we're calling it LP, liquidity providing. Okay, basically, when there's a trade happening on Uniswap, then you give some, whichever pair you're working on, but like you give some ETH, you get USD, you give USD, you get some ETH. But a portion of that, and it depends on the market. It could be like 0.3%. It could be like a BIP. It could be 10 pips. So kind of like depending on the specifics. But basically that goes to the liquidity providers. mathematically speaking, it's like a put option. Okay, that like it's exactly that. Basically, you're willing to be the one. Somebody wants to sell the asset, and you're saying like, I'm willing to buy it. Okay, it's like at this price. Mm-hmm. And so you could strategize around if you know puts, then like you could strategize around that, and basically you could be active around it, or you could be passive around it. You could say, oh, I'm providing liquidity, but just in this range. Okay, so it's gonna like, if I think all the activity is going to be between $1,500 and $1,600 in the upcoming week, I'm putting my liquidity just there, basically making it more efficient there. But if it goes outside the range, you won't be making fees, etc. So that's one thing. Another thing, other protocols, okay, like lending and borrowing. Okay, so credit. Which is something a lot of people are excited about. Again, being less of a trader, then it's kind of like less of my go-to option. But basically, you could come and say, well, I have ETH, but what if I want to long ETH? Okay, can I lend my ETH and borrow USD for it? So it kind of puts me in a position, and then use this position. And let's say there's something called squared ETH. So basically, the idea is like its value is it's a way to be long to exponentially. So you could buy squith, and you constantly pay a stream to those who are shorting it on the other side. But if you're long ETH for the short period of time, then that kind of like allows you to get exposure. And so that's kind of like there are leveraged options, but usually it's about like everything's collateralized and over collateralized in the DeFi setup. So that's another thing. And you could do like even fancier things like take ETH, take squith, right? Squared ETH, create a market. Okay, so provide liquidity of ETH and squith, and then you're basically long ETH to the power of 1.5. So it's kind of like in between them. So you could do like fancy things around that. Does that make sense up until now?
Yes. So I had a question. So I'm on the uniswap.org site, and I'm looking at this section in here called pools. And so I see some of these combinations that you talk about being a liquidity provider. And I just look at some of the big pools, and I see, for example, USDC/ETH. Have you ever done any liquidity mining, say on Uniswap? And if so, what were kind of the range of yields that you saw?
So yes, I did that. And I would also say more than that. Anybody who say like, oh, well, crypto seems to be interesting, or it's kind of like DeFi seems to be interesting. And I tell this to all our employees, and we're actually going to kind of like sponsor it internally. But anybody out there, take $1,000, okay? Consider it tuition, okay? Use that, add it to Coinbase, download a MetaMask, try to send it to yourself. Figure out you need ETH in order to send stuff, so you pay for fees, okay? So send money from yourself to yourself. Understand that costs you like $2. So making transaction, or maybe less. Right now it's actually less. So it's like 20 cents, whatever. But basically understanding that execution is actually costly in blockchains and crypto in DeFi. And when you're touching the more complicated products, so like Uniswap, etc., fees are actually substantial. Okay, so you could be paying like $20 to get into position, etc. So you're actually going to do a lot less movement, because it doesn't, unless you have a lot of capital. If you have a lot of capital, then it's a no-brainer. You kind of like yes, it costs money, but not compared to how much you're kind of like putting like in line there. If you know you're a normal person and getting into that, it's kind of like, well, hold on, I don't like burning $20 every time I get into position and out of position. Like, this game is different. The way it works in Uniswap, like right now we're at Uniswap V3, okay, which is where you can do what I said earlier. You can decide in which range you want to be. You could also do you can cover the entire range, but basically it only makes sense to do LPing between two assets that you think are going to kind of like play against one another. Sometimes one will go up and the other will go down and vice versa, etc. But they're going to be somewhat correlated between them. And you're going to be making money out of fees there. If they're not correlated and one go up and one stays the same, or one stays the same and one goes down, long term, basically you're going to end up holding all the bad assets and then like continuously selling them, selling your good assets for your bad assets. Okay, so it's kind of like you have to understand how, if you're in a position, right, and you kind of like you're providing liquidity between the price of 1,000 and 2,000. If the price goes you're kind of like selling all your ETH all the way to $1,000, and if the price goes below that, you're going to hold on only to your ETH, right? It's kind of like you're putting it between 1,000. Say you sell them at 2,000, you sell them at 1,900, et cetera, you end up, when you go outside of the position at the lower end, you end up holding the bad asset, right? ETH went down really, really, really badly, and you're holding that, and you gave away all your US dollars. And if it goes up, you sold all your ETH for the US dollars, and you end up holding all the US dollars, but you're out of ETH, right? So it's kind of like you have to keep that in mind. So you want to be mindful of cycles and what the current market looks like. Is it like crab-like? Is it like it? And this is where me as somebody who's not an active trader, then I am much more like I take multiple assets, which I'm bullish upon anyway. And so like, well, I think these two assets are both going to do really good. I'm not sure which one is better. And I could extend the value I'm getting, or kind of like I could be making more by also providing liquidity for that. And then it gets even funnier than that. In Ethereum, literally next week we move. So I don't know when this is going to be broadcast, but as of like September, somewhere between September 13th and September 15th, there's going to be a major event called the Merge. Okay, basically Ethereum moving to a proof of stake system.
What's your views on that? Yeah, what are your views on that? Okay, so you support it. It's
excellent. It's fantastic, and it means it's actually worth digging into, just because it's awesome. And I think people would kind of like really. It sounds complicated. It isn't. So we can kind of like maybe simplify it in a second. But what happens in the merge is that instead of miners wasting electricity competing to mine the next block and add another block to the blockchain, and this is a major concern and a major criticism of crypto and blockchains. Well, you're burning all this money just trying to make the next block to get a reward. And this is just like really bad for the environment. In proof of stake, you throw this competition away, and basically it becomes to being, is it my turn to add a block? Is it your turn to add a block? Like it becomes like a predetermined order, each one depending on how much staked ETH they have. They're going to be adding blocks and be rewarded for it. So staking ETH, basically, if you have ETH, great, okay, you're long ETH, you have it, okay. You could stake ETH, basically getting something like 4% APY by saying like, okay, I'm going to support the network. Basically, the idea is that people would add blocks and they want to do anything nasty, because if they do nasty things, they get slashed. It hurts their stake. So it's kind of like, well, if I have $1 billion of ETH there, I'm not going to, create two blocks at the same time, or try to create an invalid block, which again, it doesn't break the system, but it hurts the system. And so if you long ETH, you could buy ETH, or you could stake ETH, or stake ETH with a company like Lido, a project like Lido. Okay, Lido, basically, they would stake it for you. They would give you a token, staked ETH. Okay, so basically you get that, but the same way that you provide liquidity using ETH, take this yielding like asset and use that to provide liquidity. So you can, like we call it like playing with like the DeFi Lego pieces. Okay, so it's kind of like, okay, I have ETH, I stake it, I actually stake it with somebody who gives me a token in exchange of it. So I still hold it. I could go afterwards and kind of like, I'm blanking on the term, give it back to kind of like get my, whatever I staked there, and more, right, with a 4% APY on top of that. But getting this token back allows me to do other stuff in DeFi. So it reduces the opportunity cost, right? It doesn't mean you could take that and now go to the lending and borrowing, like go to Maker, okay, or Compound, okay, lend that, and let's say like put it there and get, or maybe borrow USDC dollars and put it, like keep it as a collateral there. So now you actually have back all your USD dollars. You could do whatever you wanted to do with them, but now also getting the 4% APY. Now you could take that by squared ether. This is where it gets complicated in terms of not technically complicated, but like, okay, how do you build a good strategy around that? But this is where DeFi gets exciting. Okay, this is the kind of stuff you can't do in centralized. You can, I'm going to make up here. I have an idea. Let's take the state ETH and make a token around it, and just plug it into the rest of the financial system. You can't do it in the centralized system. Like, what are you even talking about? And this is where DeFi gets super exciting. Like, how can we combine the different Lego pieces and build more and more complex stuff?
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
So, many investors will want to know, can I make more than what I'm making from my bank deposits through being a liquidity provider? And am I going to have to go through all this work and still only collect 1, 2, or maybe 3% annualized on my returns? Or is the possibilities much greater than that?
So from the get-go, staking ETH gives you 4% APY. More than that, but it gives you exposure to ETH. Now, is that a good thing? Is that a bad thing? Go hedge it with like take that ETH and like this. I honestly, like, hedging isn't my thing either. Again, I'm the technical guy, but out of the get-go, you can get 4% APY, but it does give you exposure. Maybe you're happy about this exposure, and maybe you're unhappy about that. Okay, because ETH went down from $70 to almost $5,000. Went back like to maybe $800, $850, $100. So this is a very volatile market. I am very, very bullish and very, very long ETH long term. But this is crypto. It has cycles. There's bull market, and I have no idea if within a month it's going to be higher or lower. Maybe I'm wrong, but I'm confident, and I'm betting that ETH is going to be higher 3 years from now. Okay, so I'm very bullish. I'm very long. I'm very excited about that. Not a financial advice. You should do your own homework. Like what do I know? But that's my perspective. But if you're an investor and you're an actor, I don't know if you're happy or unhappy about it, but you could either hedge against this exposure, or you could extrapolate it, right? You could like say, oh, I want to be even longer ETH. So I'm going to take all that and go kind of like, okay, squared ETH, because I think short term it would go up. I don't know. That's kind of like, and this is where the merge comes in, and less like sell pressure and whatnot. I was a PhD student. I wasn't really never into Robinhood and day trading. Like, I knew it existed, like not really excited about it. And if I invest in, and I got excited about the event, say, oh, wait, you could do this and you could do, hey, and what if you combine them this way and that way? So I very much encourage, and again, take $1,000, consider it tuition, and go play with it. Okay, it's frightening. It's like, oh, why do I mess it up? Consider this money lost. Okay, if you end up with that money back or more than that, it's just like winning the lottery. Consider it lost, and then use it. Go download MetaMask. Try to move it to a different chain. Move it to Polygon, then move it back. Understand what that means. Stake it. Provide liquidity. LPing. Take it back. Understand what are the costs for that. Look into NFTs and what do they mean. Fractionalize NFTs, and that's an entire domain you could consider. But actually do it, and that puts you in the 98th percentile. Okay, that like it puts you ahead of basically the rest of the world.
Great. I'd like to turn the discussion to regulation. Do you think some type of government regulation is needed over cryptos, DeFi, or stablecoins? And if so, what type and why?
Well, it's a good question. I'm very deep and in the know about crypto as a participant, but I am in no way a lawyer, nor an expert on policy, nor any of the likes. Okay, so I can give my own opinion, but you should take it with a grain of salt. Okay, and if you happen to live in the Bay Area or something like that, and you find like you literally meet founders wherever you go, like when you go to Starbucks or wherever, and somebody tells you a really cool idea, you can't participate because you're not an accredited investor. You're probably not an accredited investor. So this is an entire world which is close to you. There are great opportunities. As somebody who spoke with every single major VC, early stage, mid, so C, pre-seed, seed, A, B growth, and after that, anywhere from Sequoia to SoftBank, who led our latest round, to Tiger. Like basically, there are all these deals. This is where the real opportunities are. And to make us all safe, the SEC prevents you, me, and the normal people from participating in them. Okay, you won't get to play in this game. And as somebody who's a founder, and kind of, I was never planning to be a founder. Okay, I'm a tech guy. I'm a nerd. I'm a really nice. I'm not with the entrepreneurs or the douches, right? I don't want to be even in that group. No. I'm a nerdy geek guy. I stick with the rest of the software engineers. So once I got into this, kind of like this is where the real activity is. Okay. Being able to participate in companies early on and investing, this is the real opportunities, and they're close to you. And I think there were probably, you know what, it goes back to the question of DeFi and is it useful at all? We already have centralized exchanges. Like maybe in the 70s, when you couldn't look up people and projects and companies and see their financials and look into everything about them and what they do and etc., then maybe it made sense. You don't want to allow people to invest in other people. Maybe these companies don't exist, etc., because the SEC filing provided something that other people didn't have. This is 2022. And if I want to look up people and companies and what they do and partnership, I can get a lot more data than the tiny bit of information that's on the SEC filing. Okay, so from my perspective, this is a protection which its damage is much greater than its good. Okay, so and again, it's going to allow people to invest. And if they get screwed over, they get screwed over. They shouldn't invest. Again, but on the flip side, this is exactly where Dogecoin and the rest of them are really hurting. It's it's a casino. If you know it's a casino, you can go and play, take your money and say, like, I'm willing to bet. There is a chance to get 10x, knowing I could lose my pants on this. And if you want to play, go play. And if you don't want to play, don't play. But know that is a game. Don't pretend this is a different game. But on the other hand, it really prevents people from participating. And this is where DeFi is exciting. Because you have no idea what ETH is, but you heard this podcast and you kind of start and say, oh, I can send money. Like I can send to my friend on the other side of the world money right now. Like without, I don't need to ask anybody. Like the same, if I send it, it's there. It's kind of like without even thinking, nobody can control it. This is valuable. Then you start down the rabbit hole and say, oh, well, ETH is interesting. DeFi is interesting. Oh, here's Uniswap. Oh, Unitoken doesn't have, so Uniswap has a token. It doesn't get any percent of the fees, which are quite significant. Okay, like Uniswap is big, but I think everybody are betting on it because they think it has a good chance of turning the fees on. And you could decide, do you want to participate? Are you betting that it will be turned on? Or you say like, oh, it would never be turned on in Uniswap. So do your own homework, figure it out, decide, and participate. I think regulation hurts a lot. That's my personal feelings. Does that make sense?
Yes, it does. What opportunities, if any, do you see with the Ethereum competitors like a Solana, Avalanche, and others? Do you think Ethereum will likely dominate DeFi for years to come?
It's hard to say. We're definitely seeing. So there are a few things. Let's unpack that. People betting on these chains say, well, this is like Ethereum and it's just as good and it has a chance. So if it has, 1% chance of competing with it and beating it out of the market, we're still so early, then it's kind of like it makes sense, then it should be valued this and that. That being said, we call them Ethereum killers, EKs, right? And we see them come and go, and most of them don't leave a mark. Some of them are kind of like, I think the worst example, EOS. Okay, like EOS is kind of like and it's terrible. It doesn't work. Technically incompetent and whatnot, etc. Like Ethereum has a lot going for it in terms of community, people actually using it, people actually getting excited about it, building the right tooling for it, so it's much easier to participate in it. And basically, all these other chains try to connect to Ethereum because this is where the activity is happening, and they're trying to compete. But BSC is on the Asian side. BSC is the Binance Smart Contract chain or smart chain, and it's actually quite big and getting quite a lot of traction. Solana, I'm actually bullish on, but again, so there are people betting on it. I'll buy the token would go up just like Ethereum. So like that's one angle. I can't even comment on it. I have no idea. I don't know how that's going to play out. We're definitely seeing actors working on these other chains. I personally, or we as a company, are actually working quite hard on Solana and onboarding really big users and really big traders to utilize the significant trading capabilities happening there. If we talked about ETH Delta at the beginning, like order book on chain, which doesn't work on Ethereum, it does work on Solana. Okay, so it's called Serum. Okay, so there is literally an order book on there. So if we provide an API that anybody could utilize to trade on top of that. So it's kind of like, if you're familiar with an exchange API, here's an API that gets you there. Okay, so like allows you to trade on top of that. And it is a viable solution on top of Solana. Now, how is this going to play out? I have no idea. My bet would be that Ethereum is going to be significant and dominant, potentially the most significant chain going forward for the foreseeable future. But 3 caveats for that. One is that it doesn't mean it doesn't happen elsewhere too. Okay, so it's kind of like you have pieces that, or what Ethereum got is composability. So you can play with one piece and take this and use this token to land there, and then take that and if you can connect with that, actually you can get a lot of activity going into you. That's one. Second, I mentioned earlier about Bitcoin and Bitcoin Cash and kind of like a bit of the history. So Bitcoin kind of said we're going to be gold, and Ethereum jumped in and filled the gap of functionality. But there might be additional. So beyond DeFi functionality and gold, is there a third functionality which currently nobody's catering? And if so, and whether that's assets, gaming on chain, like metaverse, you name it, etc. So are there pieces out there that cannot be achieved with Bitcoin as gold and Ethereum as a functional piece? I don't know. I didn't think about all the stuff you could imagine potentially do. So there's definitely an opportunity. One potential comes down a bit to your regulatory question. It's about privacy. So, and maybe that's worth tackling and kind of even digging a bit deeper. The US dollar cash is valuable. So the fact that people use it to launder money and do all sorts of stuff is kind of yes, there are bad stuff with it, but it's worth it, right? And we have cars, and people die in car accidents, but they're okay, but it's very functional, and we use it. So it's kind of the good is kind of bigger than the cons or the negative externalities. And then you say, well, but privacy, but only if you're a con man or a scammer or something like that, or a terrorist or a money launderer or whatever, you want privacy. Everybody else should be just fine with everybody looking over their shoulder and seeing what's in there. And I encourage people to rethink that and say, maybe you donated to Planned Parenthood. Okay, or something like that, which is very controversial. Or you're in the 60s and 70s and you're contributing time, effort, or even you have business with activists, whether that's about race equality, whether that's feminism and civil rights, maybe, or a completely different angle, maybe you're participating and you have trades with Ukraine, you're in Russia and you have trades or activity and you're supporting Ukraine on the other side, or vice versa. I'm pro-Ukraine in this situation. But maybe you're doing something that wherever you are, maybe currently it's not okay, or maybe it's okay right now, but within 5 years it won't be okay. And so maybe you want your privacy. Maybe you don't want the administrator, right, or the government. And I'm anything but an extremist on this. Okay, I'm not a libertarian, which is like, no, we should have no. I'm not that. But that being said, I should have my privacy. That is actually important. It's important for civil rights to have privacy. I should be able, right? Maybe you're gay, and all of a sudden, like 15 years from now, we're like super conservative, legislation or something like. Can you get married? Can't you get married? So like also guns. Okay, like I intentionally pointing out all the questions that people have really strong opinions one way or the other. And say like, do you want to be discriminated because of your opinion? Whether we should have guns or nobody should have guns. I don't even know what's the right opinion there. But your personal opinions are yours. You should be able to act on them, and whether that's donating or participating or whatever you want to do, and not to be thrown outside of your bank. Oh no, we're not. You're banned from here. Okay, you're not allowed. We just freeze your assets, etc. So privacy, from my perspective, is important. Yes, it also allows for con man and scammers and whatnot to get away, but it's worth it from my perspective.
Right. Well, I want to thank you very much, Yuri, for coming on the show here and sharing your views. How can our listeners get in touch with you?
So everything crypto and DeFi is happening on Twitter, basically. Okay, so look up Bloxroute, okay, BLOXRUROUTE, or Uri Klarman. There's just one Uri Klarman in the world. Google me, find me on Twitter. Like, look it up. It's interesting. And again, it's slightly overwhelming when you get into that, like at the beginning, but like consider yourself, oh, I'm interested. I'm going to actually do it and do it hands-on. And once you do, you're so much ahead of the curve, you don't even know it. Okay. So it's kind of like, it's scary. Am I doing it right? Like, do it. Just go and do it. So find me on Twitter. Feel free to reach out. Also see like, okay, I mean, all sorts of conversations are happening there in the open. Some of them are important. Some of them are just funny and silly. So I'd send them that way.
Great. Fantastic, Yuri. Great to have you on the show.
Thank you, Ian. This was super fun.
Great. Likewise.
Please stay tuned for Ian's special addendum to this interview.
Since the interview was done, crypto's second largest coin behind Bitcoin and most important decentralized finance coin, known as Ethereum, successfully transitioned from an energy-intensive proof-of-work system to an energy-efficient proof-of-stake system. All the money that was going to pay for confirming transactions through the vast energy-intensive computer networks will now instead go to those who stake their Ethereum coins on the network. Thus, as of mid-October, the annual yields for staking your Ethereum is expected to increase from the previously mentioned 4% up to 7% or more, because stakers will receive money that used to be paid to the miners. As I know, there is a lot of interest in this topic. I am completely open to going more in depth with the decentralized site that Yuri mentioned in the interview called Uniswap, and share some concrete practical ways to generate income, things that I am doing for my own investments. As of this recording, current market conditions are giving well into the double-digit percentage yields on the liquidity pools. If you would like to learn how I do this and explore other opportunities in the decentralized world, join me for a live discussion inside the Chat with Traders community, currently targeted for early November. If you haven't been invited to join our new community by email, which is currently invitation only for the initial launch, it's not too late. Go to the Chat with Traders website and click on the community tab at the top menu to sign up and get an invitation. I look forward to seeing you all there.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile being seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Ditch those rookie trading apps. Get Tasty Trade, the platform for serious traders. Chart with 300 plus indicators, know your profit odds, and move fast. Trade stocks, options, futures, and more, all in one account. See why serious traders choose Tasty Trade. Visit tastytrade.com. Tasty Trade Inc. is a registered broker-dealer and FINRA, NFA, and SIPC member. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
Markets, speculation, and risk. This is the Chat with Traders podcast.
We are in episode 247. And I am Tessa, your co-host of Chat with Traders. It's been way too long, and it's about time that we have a discussion on Forex trading. But this is not your average Forex trading discussion. This is an episode that I am especially excited for you Forex traders out there, and for non-Forex traders like myself, because I got a few important key takeaways that I didn't expect. Today, our host, Ian, conducts an exciting interview with Jamal Adib. Some Forex traders may be unaware of how stop-loss hunting and market manipulation is done by the smart money. Like many Forex traders, ex-stockbroker Jamal Adib experienced early losses, which compelled him to study the inner workings of Forex trading and how stop-loss orders are hunted by the smart money. Jamal spent 4 years poring over thousands of charts of different time periods and programmed his carefully back-tested algorithms, resulting in him winning an international Forex competition. He shares his enthusiasm and much wisdom of the opportunities and dangers of trading Forex and why you need an edge. As a side note, Jamal Adib will be joining us in a live discussion inside the Chat with Traders community scheduled for November 16th, where he and Ian will continue this lively discussion on Forex. If you'd like to join this private online membership community, go to the Chat with Traders website and then inside the menu bar, click on Community. We hope to see you there. Now, ladies and gentlemen, without further delay, we are so pleased to present Jamal Adib.
Jamal, I'd like to welcome you to Chat with Traders and love to find out a little bit about your background, kind of what got you into the financial markets.
Yeah, thank you so much, Ian. It's a true honor to be on this podcast. I'm very excited. So my mom is German and my dad is Iranian. That's where my name comes from. I grew up in Germany. I went to high school there. I was always a very driven person, very proactive. I was president of the student council and all kinds of things. I graduated from high school with like a 1.3 average, which is equivalent to like an A+. I went to study a Bachelor of Science in Economics in Maastricht and also at Whitworth University in Spokane. And I did a Master of Finance also after that at EDEC Business School in Nice, France. I went also to Harvard Summer School after that. And during my studies, Ian, I already did several internships, at investment banks. For example, I was at Goldman Sachs in London. I was at Bank of America, Merrill Lynch in London. I was also at Saal Oppenheim in Frankfurt. And to make a long story short, I did my master thesis, which was about fractal finance, and I graduated. I worked as a stockbroker and investment manager, and then for the last 10 years, I basically traded Forex full time, and both manual and automated. And to be honest, this is a great point in time for a Forex interview because, as you know, Ian, the stock market is coming down as expected. We had the crypto crash. So more and more people will look at Forex now, I think.
So you have experience with equities, and I'm curious, what led you to focus just on Forex?
Yeah, that's a great question. That's correct. So, when I was a broker, I was trading a lot of equities as well as options on stocks. And I liked it a lot. What happened is I started to create own Forex systems in my free time. Back then, these systems were quite rudimentary. I mean, if I look at what I'm doing today, it was really like just some very basic statistical systems, not very complex. And what happened as well is, Ian, there was this one client, as I remember, and he used to call now and then and place Forex trades. And I saw everybody doing all kinds of things, buying equities, trading ETFs, bonds, etc., options. And this particular gentleman, he was sniping, placing Forex trades. And most of the time, they were also good trades. And I kind of got hooked, I started to research myself about Forex. And I really, found out that this is my passion within the financial markets, That's basically how it happened, yeah.
What could you share about what do you think the advantages or opportunities available in Forex that might not be available in the stock market? I've heard some traders argue that, Forex has a very limited number of choices of what you can do. And with the stock market, you have thousands of different equities you can trade, and there's more opportunity for inefficiencies. How do you respond to that?
Yes, I mean, and that particular topic, gets us straight into it. So that's right. So on the one hand, yes, we know that the foreign exchange markets are the world's largest financial markets. We have to remember that, the daily transaction volume in, let's say, euro-dollar can be 5-6 trillion US dollars. That means that if you add up all stocks in the world, we have many days where the transaction volume in Forex far exceeds, the global stock markets. So it is a massive, massive market. It's open 24/7, 24/5. It closes on Friday and opens on Sunday night. It's very liquid. The transaction costs are low. We have loads of movement. So when you look at those factors, Ian, all of that looks like really, really attractive for trading, doesn't it? You think, come on, I mean, this is really what you want if you want to, actively trade a financial market. But as we know, on the other hand, there are certain things which, show us that something is off. So, for example, Ian, when you look at the 10 biggest hedge funds in the world right now, you do not really find a single fund which is completely dedicated to Forex, So there may be pot-based funds which, have certain teams doing Forex strategies, yes. But, we don't really have a massive fund which is specialized in trading Forex only. In particular,
why is that? Why do you think that is?
That's a great question. And that the answer to that is, to make a long story short, and that's what we're going to focus on today, I guess, is market manipulation. See, Ian, so in 2013, we still had a big FX fund, which was called FX Concepts. It was managed by John Taylor. And, this fund, it did very well over decades. It had 14 billion under management, so it was big. But in 2013, it went bankrupt. And to make a long story short, Ian, what's going on in this market? And that's also why experienced traders do not want to touch it. And they are right in that sense. The market has a very particular structure and very particular dynamics. I'm completely specialized in that. And I hope that I can really shed some light on that today. And the reason for the bad statistics, which we know, for example, that over a 4-month period, 84% of traders trading Forex lose. If you increase this by another 4 months, we're talking more like 95% of traders lose money in Forex. So, you know what I mean? These are the harsh statistics. So this is a bit of a fact check. And also, Ian, as you know, you have I think 250 podcasts so far very few on Forex, isn't it?
Yes, very few.
So, the reason for that is that, first of all, as a price taker in this market, without specific knowledge on the Forex market structure, your chances of success are very, very low, because you need to understand how the so-called smart money algorithms actually operate, what kind of principles they apply to the market every single day. You see, and please also understand, these kind of topics, they are inherent to the market itself. All the broker manipulation, for example, comes on top of that. You see, we can talk about that later as well. But what I'm focusing here right now is the actual price action. Why does euro dollar, move like it does and go up and down like it does? Why does the price action look so erratic to outsiders who do not understand that market? I can explain in detail why that is the case. And by the way, I should also say clearly that, I have been publishing a large part of my work already for 4 years. So, I have this YouTube channel, I have over 630 videos there, live trades, live analysis. It's called SME FX. So you're free to go there if you want to, know a bit more about all that. But you know what I mean? It's not that I'm here since yesterday. I've actually decided already some years ago to publish that kind of work and to show the technology which we have, the charts which we have with leading information. And, at this point, Ian, around 1,000 people have been following my work, and many of those have actually become good traders in their own right. They have been also using that website I created. And, I'm very proud of that work. Also, by the way, I'm still working on this book. Maybe in the next 2 years, I will finally finish it. I'm so sorry. It takes a lot of time because most of the time I'm trading. Trading is always my priority. Everything else I do by the side. But what I'm saying is, look, as a little disclaimer, I will make some big claims in this podcast, but please understand, everybody who listens to this, first of all, there's a lot of public evidence out there. Yeah, like there are newspaper articles where, it's exactly explained which kind of entities got fined for Forex rigging. There's even a statement by the US Department of Justice explaining how certain entities have engaged in Forex manipulation. So first of all, don't take this from me. You need to, if you do your research and you find a lot of content also on my channel about that, you will see that this is basically how the market works. Also, Ian, I would like to emphasize straight away, one has to understand that this kind of market manipulation, or however you want to call it, is also necessary to a certain degree. Like Forex would be different if, these entities wouldn't be doing what they do. Right. I don't want to get too far off topic, but, if you take a historical view on things, and you go back decades, you can see that in all financial markets, to some degree, we always had, like certain things going on, by market makers, by the sell side, in that context, And also, by the way, there's not necessarily even a conflict of interest regarding the market structure, because people have to understand, when we talk about the dump money, yeah.
If you wouldn't mind me interrupting here, just because I'd love to get into that shortly. I'd like to bring it back to your background, if you wouldn't mind. And then you're in 2013, I understand you created your Forex firm.
Yeah. So what happened is, I was still a broker and investment manager. I got to know, certain people. They were founders of a big gaming firm, and we got to know each other. And they said, "Jamal, are you interested in focusing on trading?" I said, "Sure." What happened is, we actually created 2 funds. One of them was supposed to be a stock and option fund, but it never really got operational, unfortunately. It would have made a fortune because it was just before the big bull market of the last decade. But yeah, it wasn't launched. So we launched, however, like a small Forex fund. And, I started basically focusing on Forex spot trading. And at the beginning back then, it didn't go very well because, all the systems I had put together, they were not really, consistent. So, it was at a point where I was like, oh, this is not as I thought. However, what happened then, Ian, is, first of all, I got to know with, some really good people, some really good programmers. One in particular, I'm not sure whether he wants his name mentioned, but we worked together and we started working on tools which analyze certain data, for example, position data, limit data, order data, you see. And we were really just tinkering. It's not that we understood how this works. You see, I should also really be humble and say that I was very motivated to get to the bottom of this. I really wanted to understand how Forex actually works. And as soon as we started, experimenting with certain tools, we quickly realized, it was like a true aha moment. I was like, okay, wait a second. Here we have those positions. Here we have certain orders accumulated. And then, the move goes against those positions, then to the accumulation of orders on the other side. So it didn't take long until I realized, okay, this game can be cracked. And, we need to, work hard and, really, really, improve our tools and get to the bottom of this. And that was a multi-year process, Ian. I worked like crazy, if I commit to something, I really, work hard. And that's basically what I did, you see. And then, the more we realized what's going on, the more. Now, I have to explain also in that context, I took a very radical approach, Ian. I said, what? First of all, I just will observe how this market structure unfolds. I will not come with any ideas or theories how it should be. No, I will simply observe how it unfolds. And then in the second phase, I will basically analyze what's going on. And then in the third step, I will, try to derive general rules from that. You see, it was really necessary because many things, which I will also explain today, are a bit counterintuitive. For example, maybe we jump a bit into that, if you don't mind, in stop hunting. No, you wanted also to talk about stop hunting.
My understanding is that you got into programming algorithms. Is that correct?
Well, so no, I should be more precise. So within the last 4 years, I also created fully automated strategies. So my own trading algos, yes. But that's basically covering my automated Forex trading. But regarding the creation of the market causality, this market structure technology, basically, I paid also programmers to, implement it, to build it. So that once the tools were good enough and we fine-tuned and everything, then I was able to formulate the complete market causality and, to formulate also those principles, how the mechanics actually unfold in real time. And that, of course, then enables you to also predict price moves, you see? So that's basically, the sequence, how it works. So in a nutshell, to summarize, first, I really, did the complete market causality. And then at a later stage, I also developed fully automated trading algos myself, you see?
Once you started implementing these fully automated systems, how was your return and drawdowns impacted by using these trading systems versus prior when you did things manually?
Yeah, I mean, that's an interesting question. So regarding my own trading, I moved more and more to automated systems. So I used to be like a fully manual trader, and I still, trade manually. Many of my trades are documented on YouTube. You can watch them, where I just basically directly trade the market causality. Yeah, so I wait for certain setups. Let's say it's a post stop hunt setup, or like a squeeze move, whatever it is, and then I traded them. Now, when it comes to my automated trading, I basically incorporated certain principles from the market causality into those strategies. Yes, but the strategies themselves are still kind of statistical. You know what I mean? So it's not that they need all the information which I use for the manual trading. And as you can see, like maybe also in the future, another time we can also talk in detail about the automated systems, how they need to be set up. It's also a topic on its own. But yeah, I mean, to answer your question, so, my strategies in my bot portfolio, they all have like a great relationship between like, net profit and maximal drawdown. Like I would say as a general rule regarding these kind of trading bots, if you can achieve, like a net profit, which is 2, 3, or 4 times higher than your maximal drawdown, then you are on a very good way. The next thing, of course, then is to try to limit the length and the depth of any drawdowns. But what you do is you have a portfolio of different strategies, of course, and then there's also a bit of diversification across, markets, time frames, strategy styles, etc. So it's a big automated trading is also a big passion of mine, and I'm willing to talk a lot about it. But maybe first we cover the causality, because that's really how the market itself works. You see.
So my understanding, in 2019, you won an international Forex competition.
That's correct. So, that is also quite a story. And I would argue that my whole path is quite an outlier, like all the things that happened, they are quite unique. And yeah, that's correct. There was a Forex competition. I was contacted. We were invited to several locations in Europe. There was a group of traders all doing Forex. And yeah, there were different stages, I think 3 stages. I won this competition also because I used the market causality. And, that was also a very, very interesting experience for sure.
Right. So did you create one program within the market causality, or did you create multiple programs for different market conditions?
Okay, so regarding the automated strategies, the bots, I run like at least 8 different ones. So it's like a strategy portfolio, yes. So these are like 8 different trading strategies. But regarding the causality, you see, that's a good chance now for me to explain that. There are like very defined setups you can trade as a price taker on the buy side, using the market causality, that leading information. I've defined them very clearly. Yeah. For example, let's say there's a dumb money switch and the dumb money goes from one side to the other, and the major stops are cleared, and like the market snaps into the opposite direction, and other very defined setups. Now it's important to understand the market causality, Ian. It's not a strategy or anything. It's how the market really is. Like how you play it or how you trade it, whether you do it manually or whether you do it in an automated way. That's kind of another chapter. In this context. So also within the market causality, there are different setups which are tradable. Now, I have shown over the years on my channel, like the setups I successfully traded, but there are more setups than that, and that's also something I've learned just in the last 2 years, also by other traders using that and coming up with their own approaches. Like there's some degree of freedom, because to be very precise, there are traders, they don't want to do day trading. They just want to place trades every few weeks. So they go to the higher time frames, like the 4-hour chart, the day chart. And for example, they just wait until the dumb money really goes significantly on one side. They do the trade and they just ride the move, like similar to traditional trend following. And if you look at Eurodollar recently, for example, which went down so much against the dumb money longies, or you look at dollar yen, which did the reverse, which went up so much against the shorties.
Chat with Traders is brought to you by Tasty Trade. Tired of trading on rookie apps? Then get the platform for serious trading. Tasty Trade. Tasty Trade gives you the tools to trade your way. Chart your heart out with over 300 indicators. Know your odds with probability of profit, and move fast with Quick Roll. Trade what you want and trade it your way. Stocks, options, futures, and more. All in one account on one platform. No wonder why serious traders choose Tasty Trade. Visit tastytrade.com and see for yourself. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
These traders, they did very well just riding the move over days and weeks, because you could literally say how the dumb money, for whatever reason, kept on trading on one side. So, so that's, for example, one way of trading it. But there are also people who love, day trading and more high frequency trading. For that, of course, you need to be more advanced. You need to have more experience, and you wait for very particular setups. Yeah, for example, let's say you see that there was a news announcement, and the dumb money goes very strongly on one side, and the market will retest the low, let's say, against the longies. These kind of things can be very tradable.
So you mentioned a lot about dumb money. So we could call that ignorant money. And so for new traders, so what aspects of Forex trading is most challenging for new traders, and how can we mitigate this?
Yes, that's a great question. First of all, allow me to emphasize, Ian, yes, we say dumb money, but we do not mean that in any disrespecting way, because these are all very intelligent people, smart people. But as you said yourself, they suffer from an informational disadvantage. That's it all. If we play poker now, Ian, yes, and you have cards and I have cards and there are cards on the table. If there's a player who can see our cards and who can also decide what the next card on the table is, you know what I mean? That creates an informational advantage for that player. That makes us the dumb money, and that makes that player the smart money. So allow me, to use a chance to emphasize, look, there are very, very intelligent people around the world, dedicated people. But unfortunately, by not understanding how the market structure actually works, they never have a real chance in successfully trading Forex. You see, and that, by the way, that brings us back to our discussion from the beginning. That's the reason why experienced traders tend to stay away from Forex, knowing that, these things are going on. They know it intuitively. You see what I mean? And that also creates this complexity and difficulty regarding Forex trading. So to answer your question regarding new traders, look, and I feel strongly about this. You do not need to, study economics or, read a lot of books. I mean, the fact is, that there's a massive gap between economic theory and reality. Yeah. And regarding, books right now, there are no great, books on the actual Forex market structure out there. I hope I can change that at some point. The best thing you can do, and really the last thing I want is this here to sound like a sales pitch, but if you would ask me, my honest answer would be, watch first of all the videos I have for my channel. Start with the educational videos, understand all the things such as the dumb money positions, the stop hunting, how news announcements are used or abused, how there are short-term games as well. Watch all these videos, study it, try to understand it, then maybe watch some of the live videos to see how this can be traded. Then, at some point, maybe subscribe to the charts. First, do demo trading, for a few weeks minimum. You need to get a feeling for how all these things unfold in front of your eyes, And then once you have passed all that, then you can think about, going live and actually trading that. On the internet, there's so much wrong information. And when you see also people's comments, on Forex trading, don't you see often that comment, it's all about discipline? Don't you see that often?
Yes. Oh, yes, definitely.
I disagree with that. It's not only about discipline. Yes, you need discipline, but it's no way enough to have discipline. You need a proven edge next to discipline. If you do not have those two components, your chances of being successful are close to zero. That is the reality. And the problem is, Ian, we have this industry out there which promotes, all these different companies. They're selling indicators, they're selling EAs, they sell courses, they do whatever. And they try to, draw this picture that everybody can just, go and open an account and start trading and make money. That is not the case, and that's also, by the way, why, I decided to make all of this also public. I always think, Ian, of this retired engineer, who maybe has savings of 200, 300K, maybe more, maybe less, whatever the amount is. He goes to the internet, he sees all these advertisements by brokers, by, trade seeding companies, whatever it is. And he thinks, come on, how difficult can it be? How difficult can it be to, create a system where my predictions are higher than 50%? And these things, they end most of the time in a horrible manner. These people, they end up getting caught into this loop. They lose all their money. They get frustrated.
So question for you, have you tested out the commercially available program trading options out there? And if you have, what are their greatest strengths and weaknesses compared to a professional Forex system, for example?
Yeah, so I have tested pretty much everything over many years, Ian. So, we're talking about 10,000s of hours. I've tested all kinds of commercial indicators as well, commercial EAs as well, all these things. Yeah, I mean, already a long time ago. My advice is clearly, everybody listening, stay away from commercial EAs. First of all, the problem is that these trading bots, which are sold online, they show you all these great curves. And the reality is that most of them are based on some kind of martingale system. So they create some stable return just to completely blow up. And I find that very, very wrong. It's misleading people. It always ends in a horrible manner, and don't fall for it. If you really are serious, about automated trading, then you need to create a strategy yourself. Nobody can do it for you. And let me be honest here. It is a multi-year process. You can't expect, and you have to do it also in the right way. You know what I mean? You need tick data. You need to incorporate a variable spread, slippage, commissions. You need to test your strategy over different data sets. You need to change and adjust your strategy. So to be honest with you, we're talking about, a few thousand lines of code, most likely. And you know what I mean? It's a complex process. Now, personally, I love that. And I have done that, and my recommendation, even to purely manual traders, is really to do some testing. Even if it's not your intent to create an automated strategy or to automate a large part of your trading, you will learn so much just by actually testing several strategies. You see?
I see. So are the commercially available products out there, are they user-friendly enough for newer traders to program in different scenarios so they can test out their ideas?
Unfortunately, the general answer to that would be no. I cannot recommend, anyone to buy, a commercial bot and then, to just test it a few weeks on demo and then to test it live. Because, and you know what, it's also difficult to explain, but for some reason, if you do not understand every single part of such a complex strategy, for some reason also, you're not in a position to know whether, for example, this is the right market condition for an automated strategy or not, you see? So I have to be very honest here and warn people because, of course, that's what many people are trying to do. They think, come on, I put down a few $100 and I buy, some strategy, online and, I can use that to trade. So in the vast majority of cases, this will not end well. However, of course, at the same time, I should also say, I'm sure that somewhere around the world, there may be one bot which is commercially available, which is not too bad. And if somebody really, invests work to understand every single component, given that the creators are willing to disclose those components, that is, maybe that can also work for someone. But, what I've seen so far, Ian, in the industry is not great. And, and that's also maybe one of the themes. I'm very interested in showing reality. I don't want to sell people any dreams, Look, if you become a doctor, Ian, you have to go through 7 years of hard studying. After that, you have to, go through all this learning as a practitioner. Now, of course, everybody can open a trading account and place some money. It's not something where there are legal restrictions, but the complexity, especially when we talk about Forex, is high. That means, to summarize that part, if you want to trade profitably, consistently, you need a proven edge. Like, for example, the market causality. It needs to be something very, sophisticated, which actually gives you an edge. It can't just be some simple statistical system. Next to all, the other things such as, discipline, mindset, etc., that needs to be a given. If you then dedicate yourself, to really commit yourself to the Forex market, you have a chance. And look, I'm in a position today, Ian, to say, yes, I mean, like, I have guided people through that, successfully. And, like the few people who know my work, some of them do very, very well. And, I'm very proud of that. But, you need to really be realistic regarding your expectations.
I see.
The Forex market is one of the most difficult financial markets to trade. That's a reality.
Yeah, so you would suggest that newer traders or people who don't have much programming experience just simply don't get involved with these commercially available program trading options. Is that correct?
That's correct. So either really create your own strategy from scratch, okay? And you don't need to be able to program, find a programmer you like, pay him to create a strategy you put together. Otherwise, the risk is that you get caught up in the actual programming and you lose the view of the strategy itself, the big picture. That's a big risk. And, really go down that path and create a strategy, and in the best case, a handful of strategies which, are consistently profitable. That means, Ian, which show you a good equity curve over, let's say, the last 8 years, for example. Yes, so that there can be drawdowns. Yes, there can be flat periods, all of that. But over, let's say, the last 8 years, including, like variable spreads, slippage and all that, the curve needs to be stable. If you are able to reach that, then, you can demo test it, forward test it. And if the strategy works live as it does in your testing, you have a chance that you can take the strategy live.
So can we get more specific, say, when we talk about dumb money and smart money, is there a noticeable difference between how the dumb money and the smart money put on their positions and place their stops?
Okay, that's a great question. And the answer is yes. It's not only a difference, it's literally the opposite. Okay, and maybe I start with a very simple example. Like there are these principles everybody seems to believe. For example, you buy a market, you place your own stop below the recent low. Now, this is the worst thing you can do. You know what I mean, you're setting yourself up to just be short-term stop hunted. Yeah. So all these things people believe for whatever reason tend to be completely wrong. And that's, by the way, why the statistics are so harsh, as we discussed at the beginning. Now, let me give you a little hint already. The dumb money tends to trade reversals. So if you would ask me, Jamal, can you please give a very simplistic example? I would say, well, most of the time, the dumb money tries to enter cheaply into markets. So trade some kind of mean reversion strategy, where they expect the price to go back to some kind of mean, some kind of average. And most of the time, that results in a failed reversal and the price going further in the previous direction, cleaning out the lows and the stops which were placed there by the money buyers, and even doing so in an exaggerated fashion until, like the ones who try to trade reversals again and again and again, lose again and again and again.
I see in your videos, you show these green and red position bars, which you say represent dumb money positions. Where can we see the smart money positions?
Okay, that's a great question. So what you see mainly on the charts is basically the dumb money trades. Yeah, their positions, their stops, the different types of stops. We come to that in a second. We do not directly see the smart money. I used to have one indicator which was actually showing certain activities by the smart money, but by reverse engineering the market, it's not even necessary to directly see the smart money, believe it or not. All you need to do is to understand certain principles, which is, like only a handful of principles. You need to understand the actual dynamics, and I would like to talk about it in a second, at least one specific example. And, that's more than enough to, to avoid being stop hunted yourself, to avoid being position hunted, to avoid getting lured into the market and ending up with a horrible position, which in the worst case ends up blowing your account. You see? Mm-hmm. So maybe let's talk about an example, Ian. So
yes.
Let's just, what you see, I mean, on the 5th of September, I sent you a chart of euro-dollar on the forward time frame. You remember? And you could see already then that, there were a lot of dumb money buyers trying to buy the market, expecting euro-dollar to do a reversal up, and many of those guys actually place their stops below the low. You remember?
Yes.
And then when you look at the screenshot from yesterday, of euro dollar, you see that it went all the way down to 0.956. So actually what happened in the days in between, more and more longies kept on buying euro dollar. And what happened? The smart money algos pushed euro dollar down again and again, creating dollar strength and taking out all the stops until today, until like 3 hours ago, where we had a little bit of shorties coming to the market. And guess what? There's a little pullback in euro dollar right now, 0.964. You see? But so let's talk a bit more in detail. Let's assume we have that scenario from the 5th of September. Let's say, it's euro dollar. Let's say the market is full of dumb money longies. Yes? Now, let's assume, Ian, that above the price, let's say back then 1.01 or whatever it was, there is a big stop target. Yeah? So like a big yellow line. Now,
a stop target. So
yes.
Are we talking about how many traders have put their stops in at very similar levels?
Exactly. So let's assume it's the same market structure like on the screenshot. There are longies in euro dollar. And let's just assume that above the price, let's say 40, 50 pips away, there is a big stock accumulation. Yeah. So where a lot of stops accumulated. Here's the thing, Ian, and that's also counterintuitive. The smart money algo has no reason whatsoever to directly push euro dollar up and take out the upper stop. Because if they would do so, Ian, all these dumb money longies, which are already in the market and their positions are above the price, they would temporarily get into profit, isn't it?
Yes.
So that's the reason why in such a scenario, the smart money will not take out even a big stop accumulation, if that would imply that some of the dumb money positions would get into profit.
Well, wouldn't they look at the size of the longs and the size of the shorts and determine, okay, well, if we push up the price, then the longies will be profitable. But if the size of the longies is relatively small compared to those who are short and have a big, many stops at a higher level, is a smart money tempted then to just say, okay, that's okay, we'll let some of the longies make some profit and we'll drive up the price to hit these stops, forcing the shorts to cover their stops? And if that is the case, does a smart money calculate the amount of money necessary to push up the price to trigger these stop losses? And do they ever come into a situation where it's not really worth it? They calculate the amount cost to push up the price and then they back away because it's too expensive?
Okay, that's an excellent comment, and you are exactly right. That's exactly how it is. So that's right, exactly like you say. So, and that's also where we get to a bit more advanced topics such as the dumb money tolerance. So there is some dumb money tolerance around the price. Otherwise, the market wouldn't move as much as it did. But let me give you a very good example to explain this point which you have talked about now, because that makes it, I think, very clear. Let's assume, Ian, exactly like you say, we have dumb money longies in the market, yeah? There is a stop above the price, yeah, of the dumb money shorties. Now, let's assume, Ian, that we have a big news item. Let's say US unemployment being published, yes?
Yes.
Now, guess what? Let's say the unemployment rate is way lower than expected, 2% lower than expected. So what does the smart money do? They push euro dollar down against all these longies, taking them out and pricing in this, let's say, economic plausibility for the outside world, because it looks like, come on, the dollar got stronger against the euro because unemployment in the US was lower than expected. Therefore, euro dollar went down, isn't it?
Right. That makes sense.
Now, but let's now take the opposite scenario where the news result is suddenly much worse than expected. Okay, so unemployment is suddenly 2% higher than expected. So they would need to let euro dollar go up, and have some dollar weakness in order to price it in. Now, in this scenario we discussed, we said we have longies in the market, so those longies would win. So, but we also said there's a stop above the price. So guess what, Ian? They go up, they quickly take the stop out, which was on the upper side, like 40, 50 pips of the shorties. And what do, Ian? They instantly go down again. And that's a typical price action we see these days. And that, by the way, is the reason why you don't have news traders anymore in Forex. Because the willingness, exactly like you said before, Ian, the willingness of the smart money to either go after the dumb money positions or to go, after a specific stop area or to create some economic possibility, of course, fully depends on the amount of, like the dumb money as well as, the overall market structure. It's exactly like you said. And also what you said in the second sentence is true as well. There are scenarios where, the picture is not clear enough. And by the way, these are the cases where we as causality traders stay away because we are not at par with the smart money. Yeah, we are not 10 steps behind them like the dumb money, but we as causality traders are still 2 or 3 steps behind the smart money. So we wait for very clear situations. Whenever there is a scenario like the one you described, where you cannot clearly see which of the factors will be prioritized by the smart money algos, we don't risk our capital.
I see. Would it make sense for the dumb money to not use regular stop loss orders and just use mental stop losses? Because by using a regular stop loss, they make their intentions known and puts a big bullseye on their forehead for the smart money to run their stops.
Unfortunately, Ian, the answer to that question is no, because if you do not use a stop in your trading, your downside is unlimited. So one single move could blow your account. You have to use stops one way or another to protect your downside, But what you say, excellent that you say it, because many people come to that conclusion. And guess what? That's a trap in itself. Because if you don't use a stop, eventually, Ian, there will be some move which is so unusual. Remember, for example, the Euro Swissy and the so-called flash crash, thousands of pips in movements, etc., where you put your whole account at risk. So the solution to that is not to not use stops. However, I have to say, in all fairness, that why I also recently more and more promote using stops yourself and actually going for balanced risk return, etc. There are people who trade the causality and they do not place a stop order in the market. However, Ian, they either already place a hedge. So let's say they want to buy euro dollar, they already place a sell stop below the price where their position will be hedged. Or if they don't even do that, they will use very low leverage in. Like that's another thing. You can destroy any strategy by over leveraging. Yeah, even the causality. If you don't use reasonable risk parameters, you can still mess it up.
Right. I'm curious, where does the smart money hang out? I mean, I've heard of this thing called dark pools. Do many of their transactions and their positions, if we had access to the dark pools, could we see their positions in there?
Yes. So, yes. So first of all, think about the smart money players as some kind of cartel. They will not trade against each other. It wouldn't make any sense. Similar to the prisoner's dilemma, in economics, they will not end up trading against each other. Their algorithms are aligned. They don't need manual intervention. This is all automated. This is done by, like programmers. They use certain things such as dark pools and other things, I'm sure, to align, like the overall market making process, let's say. And, they have price control. And please, again, I would like to emphasize that don't take it from me, I mean, I've done a video where I have summarized it and I've put together some news articles and all kinds of evidence, you see. But I can tell you right now, Ian, if you talk to any senior professional from the industry, whether it's an investment banker, whatever, they all know exactly what's going on. And again, allow me to emphasize once more, Ian, all of this may be necessary to a certain point. Because think about it, Ian. If you would be a market maker and you just earn the spread between the bid and ask, would you take the full price risk? I mean, there is no perfect hedge neither. You see, like it's intuitive that, there is some control also on the market by certain entities, which provide liquidity, as it's called. If you ask me, it has never really been different also in historical terms in any financial markets, like the difference is, Ian, that these days, we went through a whole phase of algorithmization, of automation. That's the difference. Like the market is efficient in the sense of the fact that it's a fully oiled machine and what they do works very well for them, and it's very repetitive. You see? And to come back to our discussion at the beginning, please, if you are a novice and you listen to all that, understand this is why you need to understand how this works if you want to trade successfully, because otherwise you simply fall victim to those games which are played. As simple as that.
Can retail traders ever get access to seeing dark pool activity and therefore adjusting their trading strategy?
Retail traders do not really have a chance to get access to any of that. I mean, I offer to see my charts on the website. You can subscribe. It's called MK Web, and you see my charts live with everything on it. You see, that seems to be the best chance they have. And please understand again, Ian, I'm a full-time trader. I created this product because that's what I would have needed myself when I started out. You see, if when I first started out in Forex, had this tool, I would have been the happiest man in the world. It didn't exist. So, I created it. And by the way, I created that after I published, these principles, because I started around 4 years ago publishing screenshots and predictions and all that. And then some people said, okay, Jamal, we got it, but can you offer something? So I had to go back to the drawing board, put together a plan to make it possible that people can see that chart and trade them, So that was the whole process, and it took a lot of time because, as I said before, I'm trading first and foremost. So I did that kind of by the side, but yeah, it's completed and people can use that. But look, I mean, the important message here is that there's an informational advantage by these players. If you do not put in the homework, you're easy prey, and there's no simple solution to that. If you say, okay, you know what, I will just not use stops, so I can't get stopped out. What happens? You will eventually end up on the dumb money side, and you will have a big drawdown. And what happens then, Ian? People try to average down. They try to trade at cheaper prices, and the whole downward spiral gets worse and worse and worse.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
Does a typical Forex trading platforms allow traders to see where all the stop losses are and at what levels?
Not really. I mean, as far as I know, the last time I checked, which is a while ago, I mean, they're out there. There are different commercial offerings, like there used to be like services where you could at least see, let's say, some stops or something. Unfortunately, Ian, this is not enough. And maybe explain that, because that brings us also to the next point. Look, stops in particular, Ian, yes, they are important, but they are not the dominant factor as such, because guess what? If you have a clear target above the price, let's say you have a big medium-term stop accumulation, yes, you know that eventually it will be taken. However, on average, I would estimate that around 8 to 10 counter moves will be implemented by the smart money algos before they do the actual main target run. You see, I call this pre-main run counter move. You understand?
Mm-hmm.
And that's maybe something we should explain a bit, because that's also where people can get a flavor. And that's also where things are a little bit counterintuitive, because look, most of us, if we see a big line on the chart and we know, okay, the price wants to take that level, we tend to say, okay, I buy towards the line. But no, if you want to be more sophisticated and accurate, you need to understand things such as the time and range principle. The smart money algos, Ian, are not in a rush. They do not need to quickly take out any stop for that matter, you see? Mm-hmm. Like, they have all time in the world. So what do? They make sure that any dumb money positions which are placed in front of that target are what I call priced in. There are counter moves against them. Sometimes the market goes flat for 10 hours just to make sure if there are any day traders, whatever, who try to trade towards the upper target, they close their position before the move. You see, now it's important to understand by implementing those principles, such as the pre-main run counter principle and the time and range principle and so on, by implementing them constantly, they make sure, Ian, that on the dumb money side, no matter whether people bought or sold, or whether they trade reversals or breakouts or pullbacks, or whether they're scalping, as a collective, not individually, but as a collective, they lose. You see, and that's hopefully something which is now, also a realization for people listening to this, because it's also counterintuitive, Ian. No, you would say, come on. I mean, first of all, when we look at the naked price chart, there are big trends, they exist. There are breakouts, which, are followed by a proper move. There are reversals where the market suddenly completely changes direction. These things exist on the naked chart. But, one has to understand how the mechanics are, because the price is just the output from the market structure, not the other way around.
So just to summarize, the word stop hunting is a word that you use to describe a cartel-like action of smart money that concentrates their trades to push the price up or down to hit stop losses, which will then trigger a cascading sell-off, for example, which will push the price down further and then thereby enable the smart money to flip their positions at a profit. Is that accurate?
That's correct. That's exactly right. So that means that the stop targets are kind of the final phase. These are the moves. So the price moves towards those target levels. They are kind of the last phase where the smart money finishes up, because first of all, market participants who have the stops at those levels, they get kicked out at a loss. Yeah. The ones who didn't use stops, they may get are over leveraged in the worst case. They get a margin call. The ones who try to just hold over, they may get into a deep and long drawdown. So that's exactly right. We often see these days, Ian, that the market goes to the target level, and then once by the pip almost, the target has been cleared, they snap back up. You see, like that's typical house clean moves we see a lot these days. This is why, Forex is destroying so many simplistic systems. The ones who try to trade trends, they get whipsawed. The ones who try to trade reversals, they suffer from failed reversals over and over again. You see, like this erratic price action, which looks, very irregular to like the outsider, is the result of these kind of constellations. As simple as that. To the point where sometimes, and again, please watch all the videos I posted over the years. It's very repetitive. You see these things. Often I could capture it on camera. How the price goes exactly to the target and then snaps all the way back up once the target has been cleared. There is no way for someone sitting at a naked price chart, to cope with that, if you ask me.
I see. Can you give us a specific example of what you look for to enter and exit from a trade?
Sure. So that depends on, which kind of setup I'm trading. I mean, let's talk about a few specific examples. So let's talk about maybe the post-stop hunt trade, because, this is an easier setup to trade. So that's in a situation where the market overall is rather ranging. There is a clear target. The target gets taken out. The price overshoots maybe a little, and then the price falls back into the range. This can be tradable because, like you can see in front of you that the job is finished. The stops have been cleared. The dump money goes also to the opposite direction, so that's the other thing. Like most of the time when you observe the causality live, you will be surprised how well the smart money algos tricks work, like they work over and over again. Sometimes by simply drawing a certain pattern on the chart, let's say, like they draw like a double top. So people for some reason think a double top is a place to sell the market. And then suddenly, there's a big, strong price bar to the upside. And what looked beforehand as a double top doesn't now look like a double top at all. Like it looks just like, some messy price action, you see? So
I see. And that's a direct result of there being a lot of stop losses right above that double top for them to trigger. And if there wasn't those stop losses there, for example, or say the amount was very small, would the smart money say, hey, it's not really worth fooling with this here?
that's exactly the point. And that's the reason, Ian, why, of course, if you look at the historic chart, of course you find double tops and double bottoms, and W's. Of course you find these patterns. But like you said, exactly like you said, the only reason why these patterns then were successful is because, either the money was again on the wrong side, or the job has been completed, the main target has been cleared out. You see, that's exactly right. So now to come back to your question, so one particular setup would be, for example, to wait and then trade the counter move after the stop one. But let's talk about a second setup, the so-called dumb money switch, because right now when you look at euro dollar, you see this nice move up. And if you would see my charts, you would see that the dumb money switched from long to short. So within the last 8-9 hours, we suddenly have dumb money sellers coming into the market, the red bars. That is the only reason why right now, as we speak, euro dollar is going up against those shorties. Such a setup, I call it dumb money switch, because the dumb money literally switches from one side to the other, can be, for example, a tradable setup. What we typically do in those cases is we wait at least until the previous low has been cleared, which has happened here, by the way. So the low in euro dollar around the 0.9566 level had been cleared. And then the price comes back up into the range, and dumb money sellers keep on coming into the market. In that case, you can buy and trade the actual dumb money switch. This is a second example. But allow me to give you a third example, which is very relevant looking at the recent weeks, which is a squeeze. And I feel very strongly about that one because people are so confused. When you look at dollar yen, Ian, since Feb this year, it went up 3,000 pips, isn't it?
Yeah, it was a big move.
You see, they went up and up. There were only two pullbacks even. Apart from that, it was like a strong move to the upside. Now, that's a typical squeeze move. And we actually have a separate indicator. That's the indicator you see on the bottom of the chart, where the squeeze itself gets shown. This indicator shows you overall, is the dump money overall rather long or rather short, and is it increasing in that direction? And this is a typical squeeze move. That means, for whatever reason, Ian, the dump money keeps on selling into the market over weeks in this case, which is crazy, and the price goes up. Now, you can, as a causality trader, you can trade that, but you will, of course, trade at expensive prices there. That's something where people sometimes have a psychological barrier. And again, it looks like counterintuitive because you see a chart which already went from the lower left corner of your screen to the upper right, and then you decide to buy it, after it came up so much. But you can absolutely do that if you are a causality trader. You can enter expensively into the market and write, the next 100 pips up. And, and personally, also, I recommend yourself in those cases to use a clear stop, just in case, that for example, there's a dumb money switch, or, dumb money leaves the market all of a sudden and the price actually turns, you just get out. You understand?
I see. So on your videos, I noticed that you have these position bars where you show where the smart money is, and then both long and short, and then the stop levels. Do you adjust your trading strategy such that you will wait until those stops get cleared out first? Do you take that into consideration?
Well, I'm obviously experienced, so I also trade towards the targets. So and allow me to elaborate. If and that's actually also a good strategy. If you see, first of all, Ian, it's important that there are three different types of stops. Okay, there are short-term stops, there are medium-term stops, and there are long-term stops. On our charts, you see the medium-term stops as orange and yellow. You see the short-term stops as blue, and the long-term stops as pink. To make a long story short, Ian, the most important stops, especially when it comes to actually trading those moves themselves, are the medium-term stops. You will see quickly that eventually those medium-term stops get taken out, after the smart money algos did what they had to do. You can absolutely trade those moves. However, as I said before, you have to take into consideration that for each of those target runs towards the target, on average, there's a number of counter moves literally to the opposite direction. So what you can do, Ian, and you can also work with limit orders, by the way. That's very, very convenient. You can say, you know what? I see, let's say like cable right now. Look, there are medium-term stops around the 1.072 level. Eventually the price goes there, but also that right now, it's not a great entry price. You have some shorties in the way also, and you have stops on the upper side. So why don't you place a limit to sell, let's say 50, 60 pips above the price with the target, at the just a few pips above the medium-term stops. You see what I mean? So the causality enables you to make those kind of precise decisions. And to answer your question again, yes, I traded also on the live trades a lot of medium-term stop runs. The easiest scenarios to trade the MTS runs is within the squeeze, Ian. That means, for example, in Eurodollar also during the last weeks, and you can see the videos I've made during that time period, you see the longies are coming into the market. You see the big medium-term stops of the longies below the price. So you can literally short, even though it's an expensive entry, and you can place your own target just above the medium-term stops accumulations. And as I said before, in the best case, also your own stop in a similar distance on the upside above potential longies, because most likely if the price goes against you, it will turn again to the downside at the longy positions.
I see. So we've been talking a lot about short-term manipulation by the smart money, and I'd like to transition the conversation to government intervention and price supporting or price suppression in the long term. And as we saw last week, Japan's action in their markets by selling off U.S. treasuries and then buying their greatly weakened currency with the U.S. dollar that they just received. Was this action a surprise to you? And do you see more of this coming by other countries that have a weak currency?
Okay, that's a great topic as well. Okay, so let's talk about that. Looking at dollar yen and the example you mentioned, here's how that works in a nutshell. First of all, central banks, no matter which currency in general, they, of course, are concerned about currency rates when it comes to very large deviations from certain levels. Yeah, like the central banks literally do not really care much about short-term moves. So like a few hundred pips is nothing for them. However, as you mentioned, if we talk about a multi-thousand pip move, and this affects like whole economies and world trade as it does, no question about it. Of course, the central banks eventually will do something. However, let's take a close look what they did exactly. Now, when dollar yen went up already, I think like 2,200, 2,300 pips, the Japanese central bank started to make certain comments, so they start, like always, they start to, give certain announcements, unscheduled announcements in the press, which then end up on our squawk boxes, etc. And as you remember, before the last statement, they already said, looking at recent forex prices, we will consider, what to do monetary policy-wise, or, like how this will affect trade, etc. Now, the reality is, first of all, it's all a little bit of a game, because the central bank is aware that any comments they make in this direction can already change currency prices. They know that very well. In fact, as a footnote, there's a whole economic theory how you can manage inflation expectations, interest rate change expectations, etc. However, as you can see, what happened after they started to make those comments, shorties came in the market again. So the market went up, another good 1,000 pips, up to the point where we talked about like 144, 145. And then, at those kind of price levels, they started to, make stronger statements, and the market started to lose momentum. So what I want to say, to make a long story short, is to summarize the whole case. And it's interesting that you brought it up, because, that's a bit more advanced. Yes, the central banks will, of course, always have in mind what the forex market is doing. But first of all, they're certainly not concerned about short-term price movements. In my personal opinion, Ian, they are very well aware of all these dynamics I've discussed today. But, it's not that is something which is very important for them. Whenever a market goes really out of line and we have serious macroeconomic consequences, like in this case, they eventually will do something. However, let's be honest here also. At the end of the day, Ian, look, Japan with this weak yen will have, a lot of exporting. You see, so since the country is a big exporting country, it may be in their interest, even at least for a certain time period, to have a weaker currency, because that can sometimes boost, exports and all that. You see what I mean? So considering that there's the distinction between policy-making entities and monetary politicians, and businesses, and the domestic economy and their potential to export, etc. Overall, when you look at the big picture, you can see there are different interests at stake.
Yeah, that's a good description. So wrapping up, what key advice would you give to new traders in the Forex market?
Okay, so first and foremost, after this little insight you got today, yeah, be aware that when you're starting out as a trader and you want to focus on Forex, the odds are really against you. That's a fact. Take this as a given. Now, if you're really, really, let's say, as crazy as me, and you're as, passionate about the market as me, and you're willing to put in effort, yes, and to put in hours, and to learn how you can trade that market, and you're serious about it, yes, this is achievable. Okay, be realistic. You will not get rich overnight. Okay, you will not make loads of money in your first 2-3 years. But if you, have the discipline which is required in this game, if you put in the hours, if you set yourself up for success by having a proven edge, by having your risk management in place and all these things, it can be an amazing path for you. Okay, the potential is there. It has certain aspects no other financial market can offer you. Okay, and if you are in control, okay, it's an awesome thing to do, because you're not just trading some small peripheral market, some futures on a particular bond or whatever. You are basically kind of trading the world. But if you want to be successful in this endeavor, be realistic. Okay, do not believe what's shown to you on the internet. Always understand what are the incentives of the people talking and explaining. You know what I mean? Like, are they actual traders? What's the evidence? Have they actually over a longer time period also shown how things really work, or do they just want to make a quick buck? Okay, be very, very skeptical. And then look, the upside in this journey is, first of all, Ian, you will get to know yourself on a very deep level, because believe it or not, by trying to become a successful trader, you will really understand your own psychology. You will understand your emotions, okay, your incentives. You will understand a lot of truth about yourself, because it is necessary that you know yourself very well. Otherwise, you will make mistakes, you will quickly lose money, and you will become a victim, to other market participants who are very well prepared in this game. So be aware that whenever you click the button in Forex, you made a decision where you are very confident that this risk you took on that trade is worth it, and other institutions around the world and brilliant minds around the world will be beaten eventually by that decision you made. And
wow.
since it's very necessary to be very humble as a trader, and that's, by the way, Ian, as you know better than me, all the good traders, they are nice people, they're very humble, they can't afford to be arrogant. You cannot afford to be arrogant or ignorant in this game. Stop, coming with ideas or expectations or theories to the game. Stop it. Take reality as it is. Okay, try to become the best decision maker you can be. Okay, have realistic expectations. Do your homework. I mean, I could show you on my screen now. For years, Ian, I have made screenshots from every single market. Sometimes, every few hours, I have thousands, 10,000s of screenshots. In order to come to this stage today, I had to go through a very long process. It was a lot of pain, let me be honest. But, look, I could, by documenting these factors, I was able in the end, by never giving up, to come to this position today. where, I can give you that information firsthand. And, that's the reason also why I was really excited to be on your show today.
Thank you very much for coming on the show, Jamal. How can our listeners get in touch with you?
Yeah. So if you are interested in that kind of stuff, my YouTube channel is called SMEFX. I still do some live updates there. I don't do so much live trading anymore these days. But, on a regular basis, I still post videos there. The website is www.sme-fx.com. So there, there's also a forum. You can talk to others who have, learned to become causality traders. You can consider to subscribe to, the screenshots and all that. I'm very honored I was able to be on the podcast. Keep on doing what you're doing, guys. It's great. I really appreciate your efforts, to talk to traders around the world. It's so interesting. I've been listening to your podcasts for quite some years. And it's, even if there's some trader who trades a different market, it's always interesting to, get insights, regarding their methods, their thoughts. So what you're doing is fantastic. It's probably the modern equivalent to Jack Schwager's Market Wizards.
Well, great. Thank you very much, Jamal. Looking forward to talking with you again soon.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Ditch those rookie trading apps. Get Tasty Trade, the platform for serious traders. Chart with 300 plus indicators, know your profit odds, and move fast. Trade stocks, options, futures, and more, all in one account. See why serious traders choose Tasty Trade. Visit tastytrade.com. Tasty Trade Inc. is a registered broker-dealer and FINRA, NFA, and SIPC member. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
Markets, speculation, and risk. This is the Chat with Traders podcast.
We're on episode 248, and I'm Ian, host of Chat with Traders. And we're going to mix things up just a little bit today, where Tessa will be interviewing our guest, David's son. David's background is in electrical engineering, but he got turned on to options trading over the years and appeared on the Tasty Trade show as a rising star guest. With a talent for options trading, he then went on to start his first hedge fund in 2018 and then added a second one in 2021. In this interview, Tessa discusses an overview of David's systematic options trading. It has to do with a multi-layer approach using stop losses, which is not common in options trading and even advised against, and how David takes advantage of high implied volatility, not in the way most option traders would think, and his take on managing the win size to loss size ratio. This episode assumes that you do have some basic level of options trading knowledge. So, options traders, I think you're in for a treat and may come away with some actionable ideas. By the way, David will make an appearance inside the Chat with Traders community, where I will dive deeper with David into the mechanics of his strategy. Please join us in this live online discussion on December 7th. Go to community on the Chat with Traders website to join. We hope to see you there. We would now like to introduce you to our guest, David Sun.
Hi, David. Welcome to Chat with Traders.
Hey, Tessa. Thanks for having me on.
Yes, it's very good to have you on. We have a lot to cover, and why don't we just dive into it now? But before we get into the nuts and bolts of things, I usually like to hear a little bit more about the human side of traders. So if you don't mind, can you just share with us a little bit about yourself, your background?
Yeah, no problem. So my background's actually in electrical engineering. So that's my education. And so I don't have a formal finance background. I got into options when I was actually doing my master's, and it was a buddy at grad school that got me into options. At the time, I randomly just wanted to get into the market because I think it was like the 2008, 2009 time. So obviously the markets and the stock market in general was kind of on people's minds, whether or not they were, into trading. And at the time, I had no knowledge. I was just randomly watching CNBC and like following Jim Cramer and just picking stocks. And so my buddy got me into options. Interestingly enough, actually from the point of view of selling options, because I know people who tend to get into it as buyers of options and almost like speculating directionally. So I was actually selling puts very early on, for better or for worse. And again, not knowing really anything and just kind of blindly selling puts. I wasn't even rolling. I was just like picking based on how much premium I wanted, thinking like, hey, if I collect this amount of premium, then I can make this percent. And I think occasionally, if it did get challenged, he was like, hey, you can roll for a credit. So it was very unsophisticated. And the bad thing is it worked for a couple of years. So, made a decent amount, but then at some point the market turned and I gave a bunch of it back. So I got a little disillusioned and I kind of stopped doing it for a bit. But I had a friend who was also trying to get into the market or just doing research on stuff because he knew I was in options. So he introduced me to Tasty Trade, and this was in 2017. So that was, I guess, the beginning of like kind of the reinvigoration of my interest in options. Because if people follow Tasty Trade at all, they know that it's kind of retail oriented. There's a lot of content, a lot of stuff to learn. You kind of just, I was drinking it all up. And that, in terms of the learning curve, was kind of what accelerated things for me. So I started kind of getting a little better, and I got confident enough. This was like a year and a half in that I was doing well, and something gave me the idea that, hey, it'll be cool if I could scale up what I'm doing. And I was like, well, if I could do this for others and just kind of keep trading, but I can make money doing it. I basically started a hedge fund in late 2018. Did that, that was going well. I started a second hedge fund in 2021. And so, it's been 4 years. And so I've been kind of just continually pushing my own knowledge and developing strategies. And, that was kind of just the trajectory. Yeah. So that was like from beginning to end, probably like a 10-year journey, 10 plus years at this point. And that's kind of the very high level, quick fly through.
Mm-hmm. So from electrical engineer to options trader, now hedge fund manager.
Yes.
I wanted to back up just a little bit. Before options trading, did you just trade stocks at all? Or you just went straight into options?
So I picked stocks for like a couple of months because, as I mentioned, that was around the time I was in grad school, and I was telling my friend about it, and he got me into options. So I basically dropped stocks pretty quickly. I mean, it was still involved in a sense that I sold puts on what I would have bought stocks on. And again, very unsophisticated. It was literally like, see what Jim Cramer mentioned, or pick 5 random stocks, or it was like Apple and Visa, or like just and then just selling a put and then doing that. So yeah, I wasn't trading stocks from early on. It was basically just selling options for after like 2 or 3 months of quote unquote trying to learn the market.
Because that was kind of like what people usually start out with when they first trade options, right? On the sell side, they usually sell puts. That's kind of a popular thing to do. Is that true?
Once you get past the buying kind of calls to speculate on the upside or buying puts, selling puts and especially cash secured puts, one of the kind of the intro strategies is like the wheel, which is basically selling cash secured puts, which is selling a put on a stock where you have enough funds to take assignment and buy 100 shares of that stock if it's put to you or gets assigned, and then turning around and selling covered calls against the shares. So I think that's kind of the introductory, or like the first quote unquote safer strategies that new options traders will learn.
Right. Yeah. So I'd like to ask some questions about your hedge fund. The reason is because we've had great episodes so far that mention the use of options to trade or use them as part of a hedging of a portfolio, or options seems to be widely used in hedge funds. But I don't know if we've taken time to pick one or two strategies and really break it down far enough at the level where even though these can be advanced and complex strategies in some of these hedge funds, I think us retail traders can still get some ideas to possibly, play with and experiment with more to be able to implement into our own strategies. So I'd love to get into a little bit about that. And why start a hedge fund? Are you a founder, owner, or you just manage hedge fund?
Both actually. So a hedge fund is essentially just like a pooled investment vehicle. So there's a number of parties that pool their capital, and it's set up kind of like a limited partnership. So all the investors who are just providing capital, they're limited partners, and I am a general partner, which essentially trades the account. It's all commingled funds, just kind of like an administrator that does the books and allocates the profits proportionally to each partner. So basically, everybody gets the same return, regardless of how much they've invested. And so this kind of structure is a way to manage a large pool of capital without having to trade multiple accounts. So some people might be familiar with something called SMAs, or separately managed accounts, where you're kind of giving somebody, a manager, third-party access to your personal account. So they trade in your account, and they have something where they do a strategy, and the trades get kind of pushed to all of the different accounts at the appropriate size. But each investor still kind of keeps control of the funds, and they can see what's going on. Whereas a hedge fund, it's commingled, and that makes it easier. That's my preference, because you can think of it as trading one large account as opposed to multiple small ones. And for capital efficiency and margining, it just kind of works more easily. But to answer your question, yes, I founded, if you will, and also manage kind of two small. I mean, don't get me wrong, I'm not Ray Dalio. I'm not managing hundreds of billions of dollars. These are relatively very small in the grand scheme of things, but it's kind of a similar setup.
Yeah, I asked because it takes a certain mindset to be able to go from trader, just a regular trader, and then now to open up a hedge fund. It tells me that you have an entrepreneurial, side of you. It's hard. It's hard to be able to do that, right? To manage the business and also the money. Would you be willing to describe some of your main bread and butter hedge fund strategy that you're using?
The kind of regulation that we operate under is we can't do public marketing, so to speak, and we can't raise capital in public and talk specifically about performance and stuff. But I do share overarching philosophies and general strategies, maybe not exactly the way they're set up like in the fund. But like I said, even through my own podcast, which I think you've heard a couple episodes of, like I share kind of different facets and the approaches and ideas behind them. And so I'll give kind of an overarching philosophy behind the two funds and like what the approach is. And so one of them is using options as a tool to combine with traditional buy and hold. So, people talk about long-term passive investing. If you buy and hold SPY, right, the S&P 500 ETF, you're going to get the market returns, and it's passive, and you'll get 9 to 10% return a year or whatever it is, which is great. But once you do that, right, it's a passive approach, and you're pretty much subject to the whims of the market, and you take what the market gives. But with options and the way, because they're capital efficient and the way they're margined, you can essentially run an option strategy on top of a passive buy and hold portfolio, and it's basically an overlay. So if you think about it, if you were to run an option strategy and even target some very small return, 1, 2, 3%, whatever it is, and if you can consistently do that, and that's basically stacked on top of your buy and hold, whatever your core, it doesn't even have to be S&P, just whatever you want to typically do as a stock investor. You're basically just adding that return on top, right? So basically, you get to kind of enhance the return, if you will. So that's the approach of one. It's like you have some core portfolio, and you can consider that like a personal benchmark, if you will, something that you'd have regardless. And if you can just add a little bit on top, you're essentially kind of enhancing the yield. And so options is as a tool to basically overlay a strategy. And then the other fund is kind of more of a pure option strategy. We don't have any underlying, equities or stock, and it's kind of a, rather than a benchmark approach, it's considered an absolute return, where we're just trying to generate some target or some level of return, regardless of what the overall market or any other benchmarks are doing, and it's using pure option strategies.
So these are the two. Those
are the approaches. I haven't gotten to the strategy specifics yet, which we can dive into one of them. But that's kind of, I wanted to give a high level of kind of the approach and what you can do, and kind of my vision for how, because different funds have different mandates or different strategies or different philosophies, or kind of what they're trying to do, and that's kind of the two approaches that we happen to have.
Yeah, I'd love to dive into each of those two approaches. That'd be great, and would love to know too, because we just had a recent episode on episode 242 where we had Chris Sidio on as a guest, and he described some of the approach in his hedge fund strategy to using options more like, I think, like an insurance,
right?
With the long vol trade, and also mentioned the other side of it, having an absolute return strategy like the one that you just mentioned. Would love to also understand what the main differences are in what you're doing.
Yeah, so it's kind of interesting, and this is a good example of what I meant about kind of different mandates. So Chris's fund is meant to be a tail hedge protection for an institution or somebody that has some other portfolio that they want to protect, right? And so they would allocate some capital to Chris's fund as kind of the insurance policy. And in his fund, he broke it down to where they have one part that is the hedging, or buy and put options at S&P or whatever else, that's meant to be the protection. But he used the example of when you pay for insurance, there's always a cost, right? And there's a bleed. So if you want large protection, you're going to pay a large cost. And if you pay a large cost and this event or whatever you're protecting against never manifest, then you basically have no benefit. It's just money down the drain, right? So to offset that bleed to the extent possible, they run some other option strategies on the side that's kind of the absolute return strategy, and they're using that to quote unquote finance the cost of hedging. And so what happens is, in his kind of product, you don't really expect a return, so to speak, because under normal circumstances, the options, the income from the absolute return strategy, it's just going to go offset the bleed from the hedge. So you're not going to get like a profit from allocating with him on a normal circumstance. But the reason you do so is because if you can get that quote unquote free hedge, then when the event does happen, his fund is designed to have a large payout, a few 100%. So you get that large return on investment. And so the mandate and kind of the risk profile of, if you think of his fund as just a product, right? Because, what are ETFs and mutual funds? They're funds, they're just products. So hedge funds are just, private funds. But that's kind of his approach. Whereas the second fund I mentioned for us is, whereas we just have, because we do short-term trading, we're not trying to have some kind of large convex or tail hedge profile. We're just trying to generate, some return that's irrespective, uncorrelated to the overall market. So that's kind of one way to kind of compare and contrast, or just think of funds as different products, right? But we're just not ones you can go out and buy on, on the exchange, right? It's not some like ticker symbol we can trade.
Interesting. Okay. So let's I would love to learn more about this second hedge fund first, because since you just mentioned it, can we break that down a little bit more?
Yeah. So the approach that we take, and just to be clear, that both the first and second fund use the same types of strategies as the return or the options portion. The only difference in why the return profile is so different is because the first fund uses, index funds, for example, as a base, and options are kind of a small piece to sort of enhance that. Whereas if you separate those, drop the index funds and just focus on the options and size that up, you get a certain return with that. And so one thing I kind of want to point out is that, again, options are just tools, right? You can size them up or down and use them in different ways in conjunction with other, pieces of your portfolio to design an overall profile. So if that makes sense, like, again, with what Chris is doing with our second fund, our first fund, it's our options, but how you use it and when you use it, that's what makes a difference. But let's talk about kind of our approach on options, because when we sell options, and I know your audience probably is mostly familiar with stock trading, so they might not have intimate knowledge of like Greeks and stuff. So we'll try to keep it very basic. We'll mention that Greeks are something you have to be aware of, but you don't have to kind of dive into how they're calculated and everything. But when you sell a put, for example, depending on where you choose the strike price, and there's a delta involved with every option, and delta very simply is just a measure of how much an option price will move for every dollar move of the actual underlying. But when you look at options and look at the option chain, the delta can be kind of a proxy of the probability of profit, or the probability that that option will expire in the money at expiration. And so if you have some probability of success, and the thing is, a lot of new traders who get into option selling, they always want to focus on high win rate or high pop, probability of profit. And so they'll sell these far out of the money options that presumably will have a 80% win rate or 90% win rate. But the issue with this kind of approach is, because options are nonlinear, what happens is you have a high win rate of winning some small defined amount. But when they move against you, they can move against you very heavily. So you could have like a 5x multiple loss or 10x multiple loss. And so it doesn't matter if you have a high win rate, if when you lose big, right? You basically give it all back. So what I set out to do was, using different mechanics, I wanted to fix that win to loss ratio. So I used kind of a simple example. If I sold an option and I collected, we'll just use round numbers, $100. That's your maximum potential profit, right? You can't make any more than $100, but you can lose a lot more. And two simple mechanics I'll do. One, we will close the option at a certain profit, right? Because there's risk involved with holding them all the way to expiration. So let's say I want to capture 60% of the profit. And so this is a little thing where when people are selling options, they have to learn to kind of turn things around. I've sold something and I've collected this credit of $100 to kind of enter the position. So if that option decays and the price goes down and I buy it back or buy to close for 40, right? So I collected 60 and I paid 40. My net profit is $60, right? Which is 60% of my original max profit of 100. Does that make sense?
Yes.
Okay. Now that's taking a profit on a winner. So on the other side, we've mentioned that options can move largely against you. So I don't want to risk a 5x loss or 10x loss. So let's say I want to cap my loss at 200%, right? So if my maximum profit is $100, because that's what I collected, and I'm not willing to lose net more than $200, what I'll do is I will stop out or buy back the option if it goes to a price of 300. So if we step back, if I sold it for 100, but I paid 300 to close out and get out of the trade, I've netted a loss of 200 or 2x. Does that make sense?
Mm-hmm.
Okay. So this creates a very simple win-loss ratio, right? If I win, 60% on a winner and I lose 200% on a loser, it's like roughly a risk 3 to make 1, right? So
You've just defined your max loss.
yes.
Chat with Traders is brought to you by Tasty Trade. Tired of trading on rookie apps? Then get the platform for serious trading. Tasty Trade. Tasty Trade gives you the tools to trade your way. Chart your heart out with over 300 indicators. Know your odds with probability of profit. And move fast with Quick Roll. Trade what you want and trade it your way. Stocks, options, futures, and more. All in one account on one platform. No wonder why serious traders choose Tasty Trade. Visit tastytrade.com and see for yourself. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
In practice, and people talk about like, what if there's a big gap or what if you can't get out at that price? Those are all real considerations, but just from a theoretical standpoint, you're right. I have basically defined my win-loss ratio, win size to loss size ratio, risk to return, so to speak. And so in my podcast, I talk about this concept called expectancy hacking. And the idea is when you talk about expectancy, which is kind of how much you expect to profit on average for every trade, right? Once you factor in all the winners and losers. And I mentioned people always focus on the win rate, but they don't focus on the loss size. So if I have now fixed the win-loss ratio through my mechanics, the only thing that remains to determine my expectancy is the win rate, right? Expectancy is kind of a function of those three things: the win rate, the win size, and the loss size. Now, even if I have fixed the win-loss ratio, I don't know the future. Like I can't know exactly how much my win rate is going to be, but I know that if the win rate is high enough, right? And expectancy, you can kind of multiply it out, like your win rate times how much you win, and then minus the loss rate times how much you lose, you'll get some average expectancy per trade. And so the win rate's high enough, the expectancy will be positive. And then if it's too low, it'll be negative, right? Period. That's it. It's either above or below kind of that so-called break-even win rate. And so the only last piece is you kind of have to find a strategy. You can do back testing, or you can just kind of play around with different, mostly through back testing, at least to get some context. Obviously, you have to live trade to see if things play out. But if I have with my strategy, well, one of them that we do, and getting back to the delta, if we sell a put option, at 15 delta or whatever it is, we found that the probability of profit of such a strategy using the profit take and the stop loss, it's somewhere in the neighborhood of 87, 88%. And long story short, that basically is high enough to kind of generate a consistent positive expectancy. You have to let it play out over kind of a number of trades, right? Any one trade could still win or lose, but the idea is to look at the long-term trend, right? So after all the trades, right, and you kind of fix this win to loss ratio, at the end of the day, you look at how much you've kind of netted in terms of profit. So let's say every trade I sell, I collect $100. And if the expectancy at the end of the day, after everything's done, including all the losses, is I'm averaging about, let's call it $25 for every $100 I sell. So that's what I call kind of the premium capture rate, because when all said and done, I've netted or captured 25% of all the premium I've sold, right? And I shorten that to PCR for premium capture rate. And it's for me kind of a measure. It's like, okay, I'm basically trying to net 25 cents on the dollar, if you want to kind of bring that down to a smaller, easier number to talk about. So that concept of the expectancy hacking and the premium capture rate, using those very simple mechanics of shaping your win-loss profile and letting the win rate play out over long term in a very kind of systematic, probabilistic way. That's kind of the approach.
How do you prepare for like big spreads and slippage and things like that in your premium capture rate? How do you take that into consideration?
Right. So firstly, I've only been applying this to the most liquid of instruments, which is SPY or SPX. It can be done with ES options, E-mini, S&P futures options, or if for smaller accounts, it can also work on MES, which is the micro options, the futures options. So that's the first thing. On a very liquid instrument, the spread will be tighter, right? If you try this approach on some really low volume or meme stock, it's probably not going to work the same. So that's for one. And the other thing is to focus on longer dated options. I know recently with kind of like the meme stock and the retail and the Robinhood, mania, there's people trading very short dated, like weekly options. And you see all these videos on YouTube about like weekly paychecks and right 7DT options. The shorter dated the option, the certain parameters or Greeks about the way they move in reaction to how the market moves, that will basically cause the spreads to be wider, right? That's kind of what you're mentioning. So I generally apply these strategies to like 90 days or further, right? 90 DTE. So that's kind of one other way. And those two will mostly keep you kind of more protected in terms of having very liquid options that you're trading. But at the end of the day, you're right. There are times when you have to cross the spread, right? If volatility gets really high, or even if there's a gap, right? Again, I mentioned the caveat is that you have to kind of hope that you can control that loss amount. And sometimes, let's say you close, end of the day, and the option is sitting at close to your stop loss, right? 180% or whatever. And the next day, the market gaps down, right? Likely by the time the market opens, the price is already past your stop. Now you should still get out. But in this case, like, yes, you're going to take a stop that's higher than you anticipated. But from what I've found, with enough occurrences and long term, even with those instances where you have to cross the spread or bad slippage, you just bake that into your expectancy math, right? So let's say with that kind of perfect 3-to-1 ratio, some win rate, X win rate is going to give you Y expectancy. But you'll find through testing and live trading, with the slippage, your loss is a little bit higher than X, right? Which just means your expectancy is a little less than Y. And you just basically bake that in, right? So I sometimes get pushback about this approach of it can't work because you'll never get out, there's slippage and this and that. But my response is just embrace those things, right? If you know they happen, figure out a way to mitigate or work around them and just incorporate them into your models. And that's kind of my approach on it.
To minimize the spread and slippage possibilities from the very start, you don't really get into individual stocks, basically, right?
That's correct. For this approach, I don't. I'm focusing. Okay. It's mainly focused on right now as the S&P index, because that is in fact the most liquid.
Yeah. Okay. But if you do, if someone wants to not do that and go into like individual stocks, for example, I actually like to pick individual stocks, but that are super liquid as well. Probably not as liquid as SPX, but then if you also do that and also diversify, have not just one underlying stock, but several, maybe like say 5 to 10, would that make it less risky as well?
So that can help in the sense that if the individual, tickers you're trading aren't completely correlated, right, you're going to get some diversification of just what the market's doing. But in that case, you may not, because I actually do just use stop orders, and you may not want to do that with individual symbols, right? You may want to kind of manage them. And the thing is, if you trade longer dated options, they do move slower. So you will have time, presumably to actually look at what's going on in your portfolio. I'm like, okay, this position is approaching or it's at the level of loss that I want to take, right? So you can manually either do an adjustment or stop out or whatever it is. You may not want to leave it to just a hard stop order, because if those trigger, right, and I don't know if you've used those before, but you are at the subject, to the whims of the liquidity, right? And there's any market makers or counterparties that are willing to fill you at a reasonable price. So yeah, I think for me, I'm comfortable using kind of just typical stop orders, and this is one of those things that like people always kind of are skeptical about, but I've done it, and on this particular instrument in this particular situation. But if that's not something you're comfortable with, then yeah, the approach you can still apply, but you may want to kind of take a little bit more of a hands-on approach and exit yourself and work the order, as opposed to relying on like a hard stop or just a mechanical order.
Yeah, that's something that I think maybe most beginner options traders weren't taught to, apply actual hard stop losses versus adjusting your positions or rolling out early or closing out before expiration or just leaving it until expiration. So what are the risks of using stop losses, even on liquid like index, the SPX, for example? What are the risks of using that?
So in terms of the actual implementation, I think the main risk that people think of is, again, those weird times when the bid ask spread is really wide and you take a huge fill that's way above what you want to get out at, right? So that's kind of like the really practical consideration. So we talked about how to manage those, but I think the other more conceptual risk in this mindset of not using stops, it kind of boils down to your approach and the type of strategy you use. And what I mean is, you talk about picking individual symbols, right, and having positions and adjusting as opposed to stopping out. I kind of the way I view it is kind of opportunistic trading versus systematic trading. Right, opportunistic meaning, maybe you have a way to look for positions where you think you have an edge. Maybe you look at charts, and if you think there's some kind of bottom, you sell a put, which is, a bullish thesis, or vice versa. If you think there's kind of it's hitting a resistance, and you sell a call, right, which is kind of a bearish thesis. Or you might scan for tickers that have high volatility, right, because you think there's more premium and there's some edge there. But you're essentially kind of hunting for these different opportunities. And once you get into them, you want to, you don't want to lose, right? You don't want to take a loss. So when things don't go your way, you can adjust, you can roll, and you're almost kind of managing these on like an individual level.
Mm-hmm.
But what I wanted to get you to think about is, so my approach is more systematic, right? I'm actually, for example, selling a put option, 90 DTE, 15 delta every single day, regardless of what the market's doing. Now, if I were to say, hit a stop one day, and on that, because the market's going down, and then because I'm going to enter a new trade anyways, that trade, the new trade, is probably going to be at a different strike further out of the money, right? Because I'm always entering at the same delta, right? And so I've closed one trade that I'm losing, and I've entered another one, at a different position, maybe a different time. What does that sound like? Does that not sound like a roll? Because
Yeah, it
what
sounds
is
like
a
a
roll,
roll.
right? A roll
Yeah.
is closing one position, opening another, right?
Right.
But so the way I kind of reconcile the two is, you can talk about stops, right, and use that, it's almost like this word that shall not be spoken, right? Or what if I completely change it around? I'm not going to use the word. I'm going to say I enter multiple positions and diversify across time, and I'm constantly adjusting the delta and exposure of my book. When the market moves too much and I'm showing a profit, I want to lock in some profits and take risk off the table and kind of lighten the position size that I have, lock in gains. And when the market moves against me and I'm getting, my deltas and my risk is getting too high, I want to manage my exposure by closing some positions and opening new ones that have a slightly less delta, right? So I've said all of this, but I'm talking about it in the context of managing risk and managing exposure. But guess what? That is exactly what I do with my profit taking and stop losses, right? And so this mindset shift of I'm using what is called a stop, but it's just a tool to adjust exposure, right? And I want to kind of challenge you on one more thing. Like, let's say you have a habit of, entering at a certain DTE, and maybe regardless of what it's doing, you want to exit or roll at a certain, like, let's say Tasty Trade talks about entering at 45 days DTE and then exiting when the option's at 21 DTE because they want to avoid kind of that late cycle risk and call it gamma risk.
Right.
Or let's say you enter at a certain delta, let's say 10 delta, right? And you have a habit of rolling out to, let's say the option moves against you, the delta goes up to 20 and you want to roll it back to 10, right? That's a stop, right? A stop is just there's something that's triggering you to make an adjustment. And so this thought of, and I think what people kind of push back against is exiting a position and then being done, right? So if you enter a trade and you stop out and you don't do anything else, you just take the loss and move on, right? I guess people feel like, for one, you don't like to lose, and for two, if you think there's still some opportunity left, like you kind of want to stay in that position, you want to still be engaged with that ticker, but you want to change the exposure, right, to manage risk. But really, that you've stopped out, right? But you just re-engage in a different position. And so because my system for this particular strategy is just entering constantly, but using profit takes and stop losses to adjust the position, that's really just a continuous process of adjusting, right? So that's kind of like the message I've been kind of trying to spread. It's like I use the word stop, but like I could literally just explain what I do without using the word stop once, but it could be the same thing. And I almost feel like sometimes that would be taken better, right? So that kind of mindset shift, and that's like what I wanted to challenge people to think about differently.
I also see the difference too is when you implement stop losses, it's more systematic. It takes the emotion.
There's that too, of course, sure.
Whereas rolling, you're still stuck in it. Should I roll it now or leave it in there? There's a lot of discretionary decisions you have to make on when you roll things out.
That's true. I mean, it's funny you say discretionary, but I don't want to make assumptions, but I would hope that, for one, there should be kind of some absolute loss limit where if it's too much, you just got to move on, right? Because you got to protect your capital. But on the other hand, if you roll, yes, you want to stay in a trade or want to stay engaged with that position, but you probably should also have the same, whatever thesis you had to begin with, that thesis should still be intact, right? So if you just don't believe that position's going to have the edge or it's going to play out the way you think it is, you shouldn't roll, right? You should just get out. So I want to say that even when you roll and there's some discretion, it's almost like rather than having one rule or two rules that I use, you have like 10. You have like a set of rules, and you're still trying to stay within the confines. It's not completely without a plan,
Mm-hmm.
That's how I see it anyways.
Yeah, that just emphasizes the importance of having your trading plan in place, right? Do you adjust your strategy for periods of very high or low implied volatility? How does implied volatility, what is it, the role that it plays in your strategy?
So with the idea with expectancy hacking, which we talked about the math behind that, there's one other element, and this kind of bakes in the implied volatility that you're asking about. If I were to sell a 15 delta option at 90 DTE, the amount of premium that takes in, that's going to change with the level of implied volatility. right? But if I do, for example, a fixed one contract every day, that basically means every trade is going to collect a slightly different amount of premium based on what implied volatility is doing. Now, if I still apply the same 60% profit take, 200% stop loss, those amounts relative to each trade will stay fixed as a percentage, right? 60 and 200. But because the premium is different in absolute terms, the dollar amount will be different. So for example, on a trade that I collected $2,000 on, 60%, is going to be $1,200, right? If I only collected $1,000, then 60% is $600. So this could introduce what's called sequence risk, which is just path dependency. If through pure bad luck, I only won the small trades and I got stopped out at the big ones, that's basically going to skew the probabilities, right? Because you're essentially not sizing consistently, right? Because of the way my strategy is set up, the amount of premium you collect for me is a proxy for the amount of risk, right? Because everything is tied to that percentage relative to the credit. So the adjustment I make is I tailor the size of the trade to always target. So my phrase is called credit targeting. I'm targeting the same amount of premium per entry. So what can happen, essentially, on high IV, I will scale down the size a bit because you're collecting more premium per contract. So I don't need to sell as many contracts. And vice versa, when volatility is lower, I'll go up in contract a bit to collect, because each contract collects less premium. So by targeting a fixed level of premium, this essentially minimizes that sequence risk because every single trade is sized consistently. But again, consistently in terms of credit, not necessarily in terms of contract size. I think that's kind of a mechanic that I haven't seen people talk about, and that's something that is actually key to my type of systematic approach.
David, what exactly do you mean when you say sequence risk? Sequence?
Okay, so if let's just say I make 4 trades, and trade 1 I collect 100, trade 2 I collect 200, trade 3 I collect 100, and trade 4 I collect 200, right? So small, big, small, big. If I happen to lose all the small ones, right, the $100 ones, and lose the big ones, the $200 trades, and I win the small ones, you're not going to get the same expectancy as if, let's say, somebody else did the same strategy, but like their sequence of trades was different. They're offset, right? And their winners and losers were reversed, right? They won the big ones and they lost the small ones. Even if we trade the same approach, because one person won the big ones, whereas I won the small ones, our P&L is going to be different. So the expectancy is dependent on the sequence of events or the sequence of trades. That's sequence risk.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
But by leveling the amount of premium for every trade, I'm basically trying to eliminate that sequence risk by making each trade sized consistently. Yeah.
Okay. Equalizing it.
You don't want to be, I guess if we want to just call it bad luck. You don't want to be subject to bad luck. That's, I guess, the layman's term.
I see.
Yeah.
So you mentioned that you take a top-down approach. Can you describe what that is exactly? I think it's related to what you just mentioned about credit targeting.
So if we put all this together, and so let's just say high level, like I've tested this one strategy, and I think the long-term expectancy or PCR, premium capture rates of, let's just call it 25% for kind of use simple numbers. So if I wanted to make 10%, so if I had $100,000 and I'm trying to make 10%, 10% is 10,000, and that's the profit, the P&L I want to make in a given year. So if I'm expecting to long-term net 25% of all the premium I sell, I take my 10,000 P&L target and basically divide it by 0.25. So you get 40,000, which means if I sell 40,000 of premium in a given year, then if I net 25% of that, right, that's my $10,000 target. And so basically I have to sell $40,000 of premium. And now if I'm trading every day, there's 252 trades. I take the 40,000 and I divide it by 252. And that gives you the daily so-called credit target. And essentially the plan is if you sell that amount of premium every day and let the strategy play out, right? At the end of the year, you would have sold 40,000 in premium. And if at the end of the year you've captured 25%, you would have captured the, $10,000. And so you can kind of set a high level return target and use that to back into the size of each individual trade. And again, size in this case is determined by the amount of premium, not necessarily the contract size.
So does this only work on, this top-down approach, can it work on choosing individual stocks?
There's two ways you can look at it. If your approach is kind of systematic to a degree that it can be back tested, and there's actually quite a few off-the-shelf services people can use to back test different strategies, and you think there's some kind of consistency there in terms of the capture rate, then yes, you can kind of use that to size the trades. But if you take what's you call kind of a systematic, more of a discretionary approach, then you might need some history of live trades, right? And then log them and sort of see, hey, I use a certain amount of capital per trade, and I usually able to make X dollars, and for every dollar of risk. And once you have some kind of expectation, it's all about expectations, right? And again, it's not a prediction, right? Even with a system like mine where the PCR I think is 25%, that's going to vary year to year, right? Long term it may be 25%, maybe, right? But 1 year could be 40, 1 year could be lower, 1 year could be zero. Like this year is probably going to be zero for the one I'm running, which is fine, because again, the market's down like 25% as of the Friday, right? But it's more about if you've traded enough to kind of have some expectation of what you get out of the capital that you put at risk, then you can use it as a guideline for kind of sizing up and down. I think that would be how I would approach it, to kind of use the same philosophy, I guess.
Going back a little bit to the volatility, you mentioned something I thought was very interesting in another podcast you were on, that you use high volatility not to make more, but to make the same with less risk. I don't know if you can expand on that a little bit, give a little context to that, because I really thought that was interesting.
So that was basically baked into what I mentioned about the fact that because I'm credit targeting and you're going to cut more premium when IV is high, I naturally size down when volatility is high, which also kind of answers your question from earlier about, do I do anything different? From a strategic standpoint, there is no change to the mechanic, but because of the nature of options pricing, it naturally scales up and down in such a way that during high volatility, so if I'm targeting some X return, which means my credit target is some number, then with super high IV, I can collect the same amount of premium as my target using less contracts, smaller size in actual notional or contract size terms. And kind of that's what I mean. I don't have this approach because some when people first get into option selling, sometimes they're taught that like high volatility is opportunity, right? You stay small when IV is low, and then you throw a bunch of buying power when IV is high. Like that's when you make the most money. that's not untrue necessarily, but when IV is high, it's high for a reason, right? It's probably there's some event, the market's gonna be volatile. So you still have to be very cognizant of risk and manage the trades, right? If you want to kind of load up, so to speak, on high IV. And that's just one approach. But in my case, I just basically kind of take the opposite where like I'm actually scaling down, not because I'm like trying to be more conservative, but just because my mechanics dictate that since I'm trying to target the same level of premium, I just don't need to use as much leverage or capital or contract size when the IV is high. That's all.
When the VIX is high, or when there's a lot of option premium, wouldn't we want to take advantage of those times?
So in a manner of speaking, yes. But I kind of alluded to the fact that when VIX is high, it's high for a reason, right? And it's because the market believes that there's going to be a lot of volatility and the underlying or the S&P or whatever is going to move a lot. And when it moves a lot, right, you can be at risk, especially if you're selling options. And so the supposed edge is that because volatility is, they call it mean reverting, right? When there's a lot of fear in the market, right? Usually high levels of fear are not sustainable. And so volatility levels will come down. And so there's a supposed edge is when you sell high volatility, the edge comes in because it's not sustainable. Volatility should eventually come down. When volatility comes down, the prices of options comes down, which means, remember, when you sell high, you're selling high, buying low. That's the kind of the backwards thinking that people who first get into option selling have to get around, because we normally think of buy low, sell high, but it's sell high, buy low. So yes, there's presumably there's an opportunity that presents itself when volatility is high, but you just have to caveat with that doesn't mean, number one, you don't go all out and just blow all your buying power and sell everything, right? And on the other hand, you still have to have a plan, right? Even if there is some more edge when volatility is high, you always have to have a plan, and you have to be able to know how much risk you're actually taking and be able to manage it accordingly.
Your strategy is very data driven, right? Do you do a lot of back testing?
That's right. We do. And as I mentioned, there's a lot of I don't know if you heard of Option Omega, and there's like eDelta Pro, and those have different tickers you can test. There's Option Omega even has like 5-minute data, which you don't really need that for longer data strategy. But I know there's a lot of people who like to test like intraday strategies. But these kind of software available now for retail, like you can do a lot of different enumerations, and they're fast, right? So you're not waiting ages to do a back test. And so this kind of automated back test lends itself very well to testing systematic strategies, right? You can throw out a bunch of enumerations and different things, and just really like kind of focus on different patterns and stuff.
Mm-hmm. Yeah. So I now want to kind of get into, from your perspective, some of the misconceptions about options trading. This is for the benefit of, especially for those who are currently trading stocks and are interested in trading options, or have started, learning about options trading, but maybe stuck on moving forward. And what's your take on kind of addressing some of this misconception first about, is it riskier and is it hard to learn? And then where do you start?
Yeah, I think one of the misconceptions is that option trading has to be super leveraged. And I think that comes from more the fact that if you have access to the leverage, because the options themselves are by definition leveraged instruments, and the way the margin is used. For example, if I wanted to buy $1,000 worth of stock, right, you have to put out $1,000 of capital, right, to buy those shares. But if I wanted to have an instrument or an option that can give you the same exposure as that $1,000 of stock, your broker may only require you to put up 1/5 or even 1/10 of that as margin, and you're not even outlaying any cash, right? It's just like the margin account will be deducted and you'll see the buying power go down. And so, first of all, if people don't understand that they're leveraged, then they can unknowingly leverage a lot higher than they realize, right? So in this case, if the option is a 10-to-1 leverage instrument and I use 50% of my capital thinking, oh, I'm using half my capital, well, you're actually levered, 5 times more than you think, right? Because it's like sorry, if it's 10-to-1 margin, then you're leveraged like 500%, right? You're using 50% capital, but your notional exposure is like 500%. So I think it's more about a not misunderstanding of how the option works in terms of what the broker requires of the capital you put up. And so you can use them super leveraged, but you don't have to, right? And another misconception is like, so people like, I guess in again like the 2020, 2021, like the Robinhood and the meme stock phenomena and YOLO call buying, where you're only using options to get super crazy gains, right? 500%, 1000%. And yes, options are non-linear, meaning you can spend a little bit of cash and buy these out of the money options or have a low probability of success, but when they hit huge. But that's not the only way. In fact, that's like, we don't use options that way. Options are literally, tools. And I think that's one of the reasons like people can get lost, is because first of all, even the same symbol, right? There's options at different expirations, different maturities, there's different strikes. And so the way they behave, and then there's Greeks, which, describe how option price moves in relationship to the direction of the underlying, with relation to the level of implied volatility, with respect to, time, right? And so, again, for us, I think it's just the understanding that you can use options to express different hypotheses that you have on what the market will do, which direction to go, when it's going to happen. And I think that's kind of the beauty of it, but also the complexity. Like there's just a lot you can do. And I think really you have to kind of figure out like what your goal is, and you can craft a strategy. And then
Right.
lastly, it's like options are like for degenerates, for gambling. Like obviously you can, again, like you can buy these lotto tickets, but like really I think they don't have to be seen as a super exotic thing, and they can really be used in conjunction with kind of more modest and conservative strategies, and just kind of more as an enhancement or a way to express different opinions.
Right. And, a lot of the strategies we talked about, and not just here, but in general, people talk more about on the sell side, selling options versus buying options. I feel like there's not enough talk about, when to buy a long put, or something simple like that as a starting point, when to buy a long put or buy a long call. What do you think about that as kind of starting out, like just to learn the basics?
If coming from maybe like a stock trading background, like when you're trading stocks, you're generally kind of trading directionally, right?
Mm-hmm.
And the direction you pick may be based on some technical analysis, fundamental analysis, whatever it is that gives you a thesis. Now, if you have a direction that you want to bet on, right? Options are a tool to, again, give you leverage in a way that's capital efficient and limits your loss, right? If I pay, $50 on this out of the money call option on this stock, that's the extent of what I can lose, right? But there's that possibility to make a big gain, right? So that's kind of the appeal. So if you have an assumption, right, you can buy puts and calls as a way to express that directional opinion. Now, on kind of the more sophisticated side, people might look at kind of historical levels of volatility versus kind of what's going on in the market. And if they have an opinion that like right now volatility is very high, or the implied levels of volatility, right, like the option pricing, but they don't believe the market's going to actually be that volatile, right? So they believe the implied volatility is higher than what's going to be realized, what's actually going to happen. What I'm trying to get at is they believe the options are so-called expensive, right? This is kind of when you want to sell them. And on the vice versa, if for some reason they think there's going to be some kind of event, there's going to be volatility, but the market is kind of, the implied level is very low, and they kind of believe that it's underpricing the risk that's out there, and they believe it's cheap relative to what's going to happen, right? This is when you kind of go around and buy options. So it's the same idea of trying to buy low, sell high, but that's in relationship to what your analysis tells you about the level of volatility. It's like when you think options are priced cheap, you can buy them, right? And vice versa. So that's just another angle.
Yeah. So far, the strategy that you described with expectancy hacking, with adjusting your win size, loss size, risk reward ratio, that's a form of risk management.
Yes.
And it sounds like you have a very good, tight risk management in place. Some people, it's drilled into them too, is, you got to have risk management, you got to have that layer in there. And that's ingrained in me too, to have risk management. But at some point though, you can have so much risk management that you can almost have no edge. And what comes first? What's more important? Risk management and then edge, or edge and then risk management, or both?
If you want to trade and sell options, firstly, you have a fundamental belief that there is some edge in the mispricing or general overstatement of options, right? Because if you believe that even the market's efficient, it's hard to, you can't perfectly price the future, right? The unknown, which is why there's that supposed overstatement of volatility, overpricing of options. And all the mechanics are, like, because even if you believe that edge is there, you can't just sell options willy-nilly, because occasionally the risk is greater than the market thinks, right? And you blow up, right? And that's why you have risk management and mechanics. But something to consider is that regardless of how much edge there is, and this is something that's true for all trading, and this is just general kind of bankroll management. You know that concept that people talk about of like, if you lose 1%, then you only have to make about 1% to catch up, right? If you lose about 10%, you've got to make like 12% or something to catch up. And the extreme example is if you lose 50%, you have to make 100% to get back to zero, right? You've probably heard that there's like these charts and stuff. And that's the idea of the volatility tax. And it just means when you're talking about compounding your account, right, it's asymmetric, right? It's almost faster to compound downwards than it is to compound upwards. So my point is, regardless of how much edge you think you have or there is in a strategy, if it's not sized right, that nature of the kind of the asymmetric compounding will basically destroy whatever edge there is, because you won't, if you're too volatile, you're just kind of end up going nowhere if any one trade or any one loss kind of wipes out a huge amount of the bankroll. So like the bankroll management, that in and of itself needs to be almost considered as a mechanic, right? And that's why I'm focused so much on the credit targeting and using that as a proxy of risk, right? Because for me, I'm like, if I collect this much credit because I've told myself I'm going to get out at this level, one way I look at it is I look at all of my positions that I have open on the books. And if I have X amount of credit for open positions, I'll know that if they all get stopped out, right, at the level that I intend, right, that's the caveat, then my realized loss is, twice that, for example. And so I have kind of a general idea of like my entire book size, if that's lost, what that represents as a percentage of my portfolio. And I can use that to kind of keep the overall level in check, right? And it's always kind of being mindful, because like, regardless of how much edge there is, if you trade too big, you'll still end up going flat or negative, right? The equity curve will go the wrong way because of that idea of the asymmetric compounding of large drawdowns.
And this can apply to any kind of trading, not just options.
Yes, exactly. That's just risk management 101. That can apply to any kind of investment or trading or whatever.
Right. In this current market environment, in general, have you had to change your strategy, or you're pretty much, it doesn't matter what the market's doing?
For me, because I've already sized things in a way that I'm accepting of the potential risk. Again, back testing is not perfect, it's not to say if I back test it and I'm going to always have the exact result, right, every year moving forward. But it gives you context, right? I think for one, like you wouldn't necessarily trade a strategy that backtests terribly. Right? If all it shows is every year loses, like why would you trade it, right? Now, if a backtest shows that a strategy always wins, well, that's great. You can trade it, just take it with a grain of salt, knowing that the result may differ, right? But then if you look at a strategy and you backtest, you want to look at like, okay, so on average, maybe I can make this much percent a year, but then the drawdowns are this percent, right? You're always looking at the path, not just the destination of that strategy, right? And then once you kind of have a context of the potential path of that strategy, you can size it up and down accordingly based on your risk tolerance and whether or not you're kind of combining that with other strategies.
For those who don't trade options but are interested, this could be a little bit overwhelming, but we all have to start somewhere. And I think in general, I think the simpler you start, the better. Start very simple. I hope that we can continue the conversation of options trading into the Chat with Traders community. Thank you so much, David. I know we ran over a little bit, but this has been extremely helpful. How can listeners contact you if they want to get in touch with you?
Yeah, so I'm on Twitter. My handle is the Trade Buster, and that's actually the name of my podcast as well. So if you go to any of the typical podcast platforms, you just look for the Trade Busters, but this is plural, so like the Ghostbusters, but the Trade Busters, and then my Twitter handle at the Trade Buster.
David, thank you so much for joining me today in this interview. It's really great having you.
Yeah, thanks so much for the opportunity. It's been a blast.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Ditch those rookie trading apps. Get Tasty Trade, the platform for serious traders. Chart with 300 plus indicators, know your profit odds, and move fast. Trade stocks, options, futures, and more, all in one account. See why serious traders choose Tasty Trade. Visit tastytrade.com. Tasty Trade Inc. is a registered broker-dealer and FINRA, NFA, and SIPC member. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Hey there, traders. We are in episode 249, and I'm Tessa, co-host of Chat with Traders. It's so good to have you join us. If you're new to this podcast, thank you for being here. Warm welcome to you. If you've been a longtime listener, thank you for continuing to tune in with us. We've got a great episode for you. Starting out with juggling multiple jobs as a valet driver, firefighter, and entrepreneur, our guest, Jack Kellogg, at 18, about 6 years ago, dreamed of financial freedom, got laser focused on saving money, and learned everything he could about the stock market, and eventually turned to penny stocks. Jack's intense drive for success pushed his mental and physical health to unhealthy levels as he managed hundreds of trades and at times in illiquid, unregulated securities that often saw hundreds of % increases, quickly followed by spectacular collapses within just a few weeks. Today, our host, Ian Cox, takes us through a multifaceted discussion, including Jack's journey, which was met with setbacks and struggles, along with wisdom gained earlier than usual for someone so young. Jack's candid way of sharing is so refreshing that I can't help but feel so drawn to the deeply human side of this talented young trader. Ladies and gentlemen, we are so pleased to present Jack Kellogg.
Well, Jack, want to welcome you to Chat with Traders.
Hey, thanks for having me on.
Yeah.
It's a real honor.
I'd like to dive in a little bit about your early experience and any goals that you might have set. How old were you when you set up your first brokerage account, and what was the catalyst for you to get into the field?
So coming out of high school, I wasn't necessarily the best reader, writer, etc. I didn't like literature. The only thing I really ever liked was simple math and video games. I didn't really know too much that I could do with that. So I just kind of finished high school and knew college wasn't really an option for me. I got interested into firefighting because of the work schedule where you work 24 hours, then you have 72 hours off. And I always wanted to be an entrepreneur to gain freedom for myself and my family eventually, and not have to show up to a job every single day over and over and not really have too much free time to work on anything else. So I got started with firefighting. And while I was learning that, I was also doing valet, which was a great job. I was able to make decent money for an 18-year-old, 17, 16-year-old. And it was really cool because I was driving nice cars at a nice restaurant in Connecticut, Max downtown in the capital of Hartford. It was a great experience. And it provided me a lot of inspiration with seeing the same clientele come in every Sunday, Saturday, Friday for a nice dinner with their family. And it was really inspiring and motivational to see people with that kind of freedom where they can come and dine every week with a nice meal with their family and not really affect them because they have freedom with money. So I was very inspired to be an entrepreneur and have freedom. And as I got started into the firefighting stuff, I realized that I couldn't really make too much money doing that. Plus, some stuff that I saw, it was kind of a turnoff at the beginning. So I shifted my focus and I tried opening a couple of businesses. One, selling stuff at a mall kiosk, also selling stuff at a flea market. And those were pretty much failures. But after a little bit of time, I had some money saved up, around $10,000 from the valet job. And my New Year's resolution in 2017 was, hey, I want to invest this money into some stocks because I knew a lot of people were making money through the stock market. And I just frankly didn't have enough money to get into real estate yet, or at least I thought so. And after that, I ran into a buddy at the gym. It was probably January 3rd, January 4th. I was in the process of opening up a Robinhood account. And I ran into a friend, my buddy named Lee. We were childhood friends, but he ended up going to a different high school to play competitive hockey. and we kind of lost touch for a while. And I saw him a few years later, and he was like, "Hey, I'm getting interested in penny stocks, etc. I'm trading penny stocks. You should see this. They're crazy. They move up hundreds of percent every day." I asked him like, "Hey, how can I learn about this? This sounds interesting versus value investing, which would seem, I mean, it would take multiple years, if not decades, to see hundreds of percent returns." So he was like, "Hey, you can get started with Timothy Sykes, Investors Underground, et cetera, et cetera." And I went home and I watched a few YouTube videos, and I was pretty much immediately hooked. I was still a little skeptical at the beginning, but eventually I saw this one Supernova HTGM later that month in January of 2017, went from about $2 to $20. And I was like, wow, these really do happen. As well as this time was just a few months after dry ships and the shipping sector. So I was able to look at previous short-term history and see the crazy moves that had happened. So after that, I convinced my parents to split Timothy Sykes' Millionaire Challenge educational service with me. For the next year, I basically just studied and slowly bled out my a few $1,000 account.
How old were you at the time?
I was like 18, 19 years old.
So your parents knew that you obviously had an interest in trading. What was their attitude toward this?
My dad was very skeptical and always called it a scam because he doesn't know anyone that's made money trading penny stocks. It was very new to him. So he was just trying to protect me. And he's like, this is, you should just become an electrician, work with your hands. That's what he is, an electrician, make money that way, because you have to be very careful. And he's always very skeptical about everything. Whereas my mom was more supportive. I could have told my mom I wanted to be anything, and she would support me in that way. But my dad was very negative towards it. So it was difficult, but I had my mom's support no matter what I did, which I was thankful for.
Your early goals, if you had them, were they tied to any specific material desires that you wanted to acquire? Like, for example, a house or a fancy car?
Honestly, no. I wasn't really the thing that motivated me the most and inspired me most was the freedom where you could do whatever you want. So I didn't really have like one, I want to buy a Ferrari or I want to buy this house here. It was kind of just, I know I can buy those things, but I have to focus on gaining the freedom and growing my account. And I know those things are very far away. And if I'm able to just focus on growth and gain consistency, that's what I really want. I want to be able to prove to myself that I can do this.
What were the elements of trading that really grabbed you? Like what makes trading fascinating for you?
Probably the most interesting thing to me was you could do it in a dark room on the computer, and you could just kind of do it without having to tell anyone that you're doing it. And you could just work hard without having to deal with coworkers and other people that would get in your way. So I knew it was really me versus myself versus in a lot of other areas and occupations in life. You have people around you. Of course, you have people on the internet that you talk to while you're trading, but you can kind of pick and choose. You can block people. You can say, hey, I don't want to talk to this person. You can mute stuff. So it's very easy to kind of pick where you want to fit in versus in a lot of other areas, you're almost like, hey, you have to do this, you have to do that, etc.
Mm-hmm. Did you find the early experience of trading lonely? I mean, you had your friend Lee. Did you have a support network of other fellow traders?
No, I just had my buddy Lee, and he was really great for showing me the basics. But around like 3 months of me learning, he kind of went into e-commerce business and drop shipping and stuff like that. So he kind of stopped trading, and then it got a bit lonely. And eventually I went to Tim Sykes conference in 2017. This was September. And I talked with a bunch of traders, and I was able to develop relationships with them and create this network. And actually, one of the guys who I met down there, he put me in a group chat. And then I met this other guy who lived in Michigan. His name's Dom. And I ended up moving into an apartment with Dom later in 2018 through towards the end of 2019. So it was lonely in the beginning, but I eventually found a few friends that really helped me.
So in your view, do you think it's important to have a support network? It was important to you?
At the beginning, I didn't really want too many people kind of clouding my viewpoint. Like, I wanted a fresh mind of what I think, but eventually, after I learned about it, I realized that, hey, I need a network and a support group to learn and grow with, because it's very difficult to do it on your own.
Right. Yeah, that's a good point. Some argue that getting quick and easy profits early on is one of the worst things that can happen to a beginner trader. What's your viewpoint on this?
Yeah, I agree. Fortunately for me, I didn't make any money for the first 20 months, really. I had a couple green months within there, but I would always end up just getting it back the next month, if not more than what I'd made. So it was constantly, I learned the lesson of how easy it is to lose money over and over and over again, where I'd string together a bunch of small wins and then I'd just take a huge loss and I'd lose everything because I was stubborn. And I didn't realize that it's more about having big winners and smaller losers versus trying to win consistently and having maybe that one big loss here and there. Yeah, so for me, I learned how to lose. And a lot of my friends who started in 2020 and 2021, when we had the insane bull market, they're going through a very rough patch right now where they're consistently losing and they're super frustrated and they have a lot more money to lose. So it's a lot more dangerous just than losing a little bit of money, especially if you take on expenses and you have payments and all that stuff. Versus even a couple of my friends started this year. And I said, hey, it's a great time to start, even though you don't think it is, but you're learning a process that's going to yield you results over the long term, as long as you stay disciplined and you learned it. You're not in this game just for a quick buck. If you want to really make money, you have to trade a process for a decade.
Before you got into trading, did your family or friends consider you to be a risk taker, perhaps expressed through any of your hobbies or interests?
I was never really into gambling or playing poker at all, or any casino type games. And I didn't really like doing stunts or any dangerous sports. So I would say not really.
Were any of them a little surprised when they heard that you were getting into trading penny stocks?
Really, people's just first thought was they were more focused on just like the scam aspect. They thought that I was just getting scammed. Like, my uncle printed me out this newspaper that I still have, actually. And he was like, why penny stocks are scams, you shouldn't trade these, etc. And I think people were just more worried that I was going to lose all my money and I didn't really know what I was doing, etc.
Yeah, well, that's a good segue for us to transition to the topic of the issues with penny stocks. Let's define penny stocks. Are penny stocks any stock that's trading below $1 on any exchange?
For me, I would classify penny stocks in like a couple different categories, right? I would say that all OTC, over-the-counter stocks are penny stocks, except for larger ones like Grayscale and that type of stuff. But if you're trading stuff that's, sub-penny stocks, trip stocks, anything from 10 cents or less, $1 or less, even $5 or less, $10 or less, whatever it is, as long as it has a small market cap, I would consider it a penny stock on the OTC market. And a penny stock on small cap NASDAQ stocks, I would consider anything under $5 or $10. Usually anything under $1 is really, really a penny stock, but that's what I would say.
I see. So some stocks that you're saying that are trading below $10 or $5, they could be classified as a penny stock because their market capitalization is quite low?
Yeah. I mean, sometimes there's no difference between a stock that's below $1 with a low market cap. They could just have more shares in the float, so it's lower price for something that they did a reverse split. It was trading at 30 cents, but they did a 20-to-1 reverse split, and it's trading at $6 now. It's the same company and the same stock, it's just higher priced.
Oh, I see. What about bid-ask spreads? Are they a material issue for most over-the-counter penny stocks?
Yeah, it's definitely an issue, especially with liquid ones that nobody's watching. You could see a 30, 40, 50% spread, maybe even 100% spread. But those aren't really the stocks that I'm looking at. I'm looking at for the most active stocks, trading the most liquidity, trading the most dollar volume, because that's where you're able to enter a position without taking huge risk because of the spread.
Got it. I noticed on the website otcmarkets.com that there were over 2,200 stocks that were listed showing a price of 0. And my question is, are stocks ever delisted from the over-the-counter exchange like is done in the NASDAQ or the New York Stock Exchange?
Yeah, so actually just late last year in September, the OTC market came out with a new rule where if you're not current and pink, whatever, if you're dark and defunct, or you have the caveat emptor or whatever, they won't allow you to trade those anymore. So we lost a large majority, maybe like 25% of the stocks that I had traded the previous 2 years just became non-tradable anymore.
Could you define a little bit caveat emptor? You're saying if they get labeled as that, that's a Latin word from my understanding is buyer beware.
Yes.
How does a penny stock get that put on them?
So at first on OTC markets, you'll see them flagged for stock promotion, where it's basically just a shell company for someone to manipulate it. Instead of spending $5 million on a product or on an actual business, it's just a shell company, and they're giving $5 million to a stock promoter. And they're like, hey, pump this stock up. Well, they'll kind of create this manipulated market where there's really nothing except buyers and sellers, and they're going to try to wash sale and have a lot of trades go through and have people's eyes go on it. We're like, hey, this stock's going up in value every single day, and they're trying to lure people in to buy the stock, and eventually they're going to sell, their tens of millions of shares from 0.001 average that the insiders have, and they're going to try to sell this at $2, $5, $10 and just try to sell as many shares as they can. And you'll see some of these stocks crash like 95% in one day. And after the stock usually crashes, the OTC markets looks into it. You don't really see them get the CE during the run up. It's happened sometimes, but usually after the stock crashes, the CE gets put on, so they can't really pump it back again or try to go for round 2. And they don't let people in brokerages buy the stock anymore.
I see. So they do get an opportunity, it sounds like, to do one pump and get some money out of it, but then they're under investigation possibly after that, and then they may not get a second chance. Is that accurate?
Yeah, for the most part.
I see. Do penny stocks on the over-the-counter exchange ever evolve and move to the NASDAQ or the New York Stock Exchange?
Yeah, it happens sometimes. There was this company, this ticker LWLG, that moved from OTC to NASDAQ. And there's been a few more. There's this one that actually went from OTC to NASDAQ, and it was the single biggest runner of the entire year. It was AXTG or ATXG. What was the ticker, Ben? Yeah, that one was like 700. Yeah, ATXG. It opened at like $10, and what happened was the people that had the shares from the OTC, they weren't allowed to sell right away, and everyone just started shorting it because we started seeing a lot of those stocks that IPO'd fade this year, especially Chinese scammy ones, OTC, whatever, it's scammy. And everyone ended up shorting it, and it actually went from like $10 to it printed 2,000 at 2,000 in after hours. And I heard some horror stories that people were shorting in the 10s, 20s, 30s, 40s, and covering at 1,000 or higher and blowing up their accounts. So you do see just absolutely wild moves in the OTC, and sometimes if they do make it to the NASDAQ, they can even become more scammier.
Wow.
Yeah.
Wow. Chat with Traders is brought to you by Tasty Trade. Tired of trading on rookie apps? Then get the platform for serious trading. Tasty Trade. Tasty Trade gives you the tools to trade your way. Chart your heart out with over 300 indicators. Know your odds with probability of profit and move fast with Quick Roll. Trade what you want and trade it your way. Stocks, options, futures, and more, all in one account on one platform. No wonder why serious traders choose Tasty Trade. Visit tastytrade.com and see for yourself. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
I'd like to transition into the perceptions of penny stocks. You know, some people have images of shady, immoral characters scamming people into buying nearly worthless companies while pocketing outrageously large commissions like what we've seen in the movies Wolf of Wall Street and Boiler Room. Other than your friend initially, introducing you to penny stocks, what characteristics of penny stocks got you attracted on the over-the-counter exchange? And say, instead of the seemingly safer regulated stocks on the New York Stock Exchange or NASDAQ?
I would say that the main reason, I wasn't against trading NASDAQ at the beginning, but I just noticed that I had an act for OTC off the bat. I was able to read the stocks a lot more clear. And since they're not electronically market makered, it's actually hand market makered. So you send an order to a route, whatever, CDL, night, and they're going to manually put your order into the OTC stock. So you're able to have more time to use the level 2 and the time and sales tape, and it just creates cleaner patterns and cleaner action to read. And I was just like, okay, I think that this dip's going to hold, or I think if it breaks this level, it's going to go up. And I noticed that I was just right more times than not on OTCs versus NASDAQ. There's a lot, it's electronically market make, there's more algos, and it was harder to read. So OTCs were just more clean.
I see. So did you consider the chart patterns to be more reliable?
Yes, exactly.
I see. Is there a lack, would you say that there's not many institutional players or program trading in these type of stocks?
Yeah, I would say compared to NASDAQ and listed stocks, probably, almost none. Because they just can't play the kind of market caps and liquidity that OTC offers. But with a small account, you're able to grow. You're able to grow your money a lot quicker, a small amount. Versus, and it was easier for me to read, so that's why I chose it.
Okay, now turning to liquidity. Last week, on a strong day for the NASDAQ and the S&P 500, with both up over 2% on the day, I noticed that out of the top 200 advancers on the entire OTCmarkets.com site, only one had reached the $1 million total volume level, and the average trade was less than $1,000. Is this common during the years you've been trading penny stocks?
No. So in early 2021 and late 2022, we were seeing trillions of dollars in the OTC market. And it was really after that rule and regulation and the SEC cracked down on it, we've seen a lot less players and liquidity in OTC. But you have stocks like GTII or MMTLP, which just ran hundreds of percent with pretty decent liquidity over the last month. And those were some of the best runners we've seen this year. So it seems like it's kind of coming back a little bit. And due to seasonality, my biggest OTC months are always in February. I don't know what it is, but that's when there seems to be the most liquidity in OTCs, December and January as well. And then the rest of the year, I mean, OTCs are really dead unless there's a massive catalyst. We've seen some good weed runs, some good Bitcoin runs throughout the year sometimes, and that causes some of the related OTCs to get some volume. But other than that, it's very seasonal.
I see. So the current bear market in the major exchanges, does that heavily influence the liquidity issues?
Oh, yeah.
It does.
Mm-hmm. Yeah. The problem is right now is why we were seeing such a good OTC market is because speculation stocks were making highs over highs over highs in 2020 and early 2021. And then once Cathie Wood's fund topped, when Bitcoin topped, when all these speculation plays topped, we just saw OTCs die off because nobody wants to buy any more speculation because we started entering a bear market. And if stocks like Apple and Tesla and Amazon and these bigger cap stocks, large cap stocks, if they're not even going to hold these BS penny stocks have zero chance. Got
it. So are you seeing widening bid-ask spreads during this bear market?
Yeah, to tell you the truth, I've still made some money on OTCs this year, maybe like 100, 200 grand. But compared to what I made on them the last couple of years, like it's nothing. And I've been focusing more now on like TQQQ, SQQQ, stuff with more liquidity. And during the bear market, there's a lot more volatility in the indexes. So that's kind of what I've been shifting into trade this year. And I'm not strictly like an OTC trader. It is what I did for, if there's an OTC to trade, like I'll prefer that because I know that's what I'm best at. But if there's no OTCs, I'm not going to sit there and enforce OTC trades. I'm going to use other strategies that I've developed over the years, but I'm always just not as confident in those setups because they're just not what I've mastered. You're dealing with a lot more competition over there versus OTCs. You almost have such an advantage compared to stuff that's trading billions and billions of dollars.
I see. So are you concentrating more of your trading, say, on NASDAQ, or is there another exchange that you choose when the OTC exchange is dead?
Yeah, so I definitely concentrate more of my trading on NASDAQ when the OTCs are dead, but I'll still try to look for scammy type moves to trade because they make the most sense to me. Like, for example, Mullen Automotive is a little scammy electric vehicle company that ran from 30 cents to 60 cents this week. Made a couple of decent trades on it. And I will always prefer to trade stuff like that. I don't like trading biotechs or stuff where there's you have to understand more with the fundamentals. I like just trading stuff that's doing massive volume and it's just a straight scam because the price action makes way more sense to me.
Got it. Well, let's actually get into your process. Have you ever been a discretionary trader, or did you develop a process early on?
What do you mean by that?
Well, when you first got into trading stocks, were you purely discretionary, or did you have certain things that you looked for, like a certain checklist for you to get into a trade?
Yeah, so I really just looked for simple patterns, like the patterns that really have made me the most money over the last 5 years is just buying breakouts in a strong market. So waiting for a stock to spike, waiting for it to pull back, and then waiting to buy a breakout. I like doing it on scams because the price action is usually the most clean. And then shorting stocks that get way too overextended. And when if a stock's up 3 to 5 days in a row, it's going up every single day, I'm looking for that first day where it kind of just falls off a cliff to short. And then I also like panic dip buying, like if there's a huge crash, making sure that you have to be careful with that because panic dip buying, I've took some pretty nasty losses there because sometimes I just don't understand where the selling pressures come from and I didn't do enough due diligence. But if it's a natural type selling pressure due to stop losses and not some massive dilution, there's usually a good bounce. And I've really just used those 3 patterns over the last 5 years I just traded those and continued to scale them up. As if I'm making money, I'm using more size. If I'm losing, I'm using smaller size. And I'm just letting the market and momentum decide how much I'm going to size into. So that's a very simple explanation of what my process is.
Okay. So are you looking for, say, a certain amount of volume above average or breaking key technical resistance levels?
Yeah. So the number one thing for me is volume, because the more volume is, the less risk you have, because you're not going to get into a situation where if you buy or you short, it just opens up huge. The spread opens up and you end up taking, 3-5 times where you're planning to risk. And the slippage can be really detrimental on a liquid stocks. And for me, the best trades that I do are stocks that have the most volume, so I can size in and I can get out if it's not working. And then I'm looking for volume as my number one indicator. And my number two indicator is I'm looking at technical levels. I'm looking at the history of the stock to see, has the stock performed clean in the history, or has it been super choppy and annoying? How did the daily candles look? Right? I don't want to trade stocks that are super wicky. I want to see a nice full body candle, meaning it opens near the low of the day and it closes near the high of the day. I don't want to be trading stuff that spikes huge and then comes all the way back in, or vice versa, has a huge drop and then comes all the way back, because those are where I'll take my biggest losses. Because if something drops 50% and then bounces 300%, I'll usually short it into the bounce and get blown out. Or if I'm long something and the bottom it just starts selling off super bad, I'll end up also taking a big loss there. So I'm looking for nice, clean daily candles.
Okay. Have you experienced any large losses due to liquidity drying up?
Yeah. I have two of my biggest losses. One came from MMNFF, which was an OTC runner. In February of 2021, it spiked from 30 cents to like $1.30 over 3 to 5 days. I ended up shorting it at the open at like $1.20, and I covered it at 90 cents. And it was a good trade. Maybe I made like 50 grand on it. And then I started buying the dip and started buying 90, 80, 70, whatever. Maybe had like an 80 average. And I noticed I just had way too much size for the volume that the stock was trading. I had like 2 million shares or something, and the stock bounced a little bit and I was up a little, but I just couldn't execute my sell order because there wasn't enough volume or enough bidders. And I ended up just kind of sitting in it all day, waiting I was slowly selling it. And then at one point it just was 2 p.m. and it wasn't bouncing, and it was at like 50 cents. I was like, it was at 60 cents. I was like, I just got to get out of this. And I sold my position, and the stock was at 60 cents, but I didn't even execute my majority of my shares till 50 cents.
Oh, wow.
I ended up losing like over $300,000 on that trade. And then another trade, I was shorting this Chinese stock that ran from $10 to, I started shorting it at $200, and it had really bad liquidity where the spread was 10, 15, maybe it could open up to $20 on the spread. And the day before, they tricked me because the spread was really tight and it was trading a lot more liquidity and the price action was clean. And then the next day, they just dried up the liquidity because it was a scam. And I started shorting it, and they had control of the float. And I ended up shorting at like 200, and I covered at 250 for, it wasn't a huge loss. I maybe lost like $100,000. I short like a couple thousand shares. It was more than I wanted to risk, though. I wanted to risk like 210, 220, lose like 20, 30, 40 grand, whatever, and try to make 100 grand if it went to $1.50, because it was super extended. And then it went up and it started going parabolic to $400. And I started shorting it again because it was just getting so ridiculous. And ended up maybe losing another 50K on it, just chopping myself up because it never dropped and the liquidity got even worse. And then the next day, it was trading at like 700. So I was like, I have to try this again. The stock's up from $20 to 700. Started shorting, and I decreased my position size so I could deal with the liquidiness. And I ended up losing another 100 points on it. totaling my losses to like 250 to 300K. And then I tried it one more time. The stock went complete supernova to 2,500 per share. And I was short at the top of the stock. I had a small position short for like 2,400. And my broker said, hey, like, you can't swing this overnight. It's way too risky. And I ended up covering, and the spread at that point was like $300-400. And I ended up losing maybe like another 100K on it. So my total losses on it was like 400,000. And then the next day it gapped down like 1,000 points or something and started trading. And it slowly faded off. And now the stock's at like $20 or something. But it just, the liquidity just dried up and made it impossible to trade. And it just went way further than I expected. But my number one mistake there was I should have just hung up the cleats on it after it proved not to be a good trader after the day that they proved for it to be a good trader.
Wow. What a story. So why did the broker not allow you to hold it overnight? Were you in a margin call situation?
No, they were just lending out fake shares, right? So in my, I'm not going to name the broker, but in my humble opinion, it was naked shorts. So they weren't allowing people to hold it overnight because they didn't really have shares. They were just lending shares out of thin air. So they don't have the locate to let people hold this overnight.
Oh, wow. So as a result of this experience, did you set a rule for yourself so that in future trades you would have a maximum position size, say percentage, as a percentage of total dollar volume?
Yeah, I would say that for now I've really learned my lesson where the last year I was aware of a liquid stocks, but I've never experienced a scam go to $2,500. And at the time it was like top 10 New York Stock Exchange stock on the market. And the market cap, I think, was like $500 billion. And the company has zero revenue. It's a complete scam. I just never really expected that to ever happen. And it was just a good learning experience that I really learned how people actually blew up, because before I would hear stories of like, hey, this guy's blowing up on this. And I'm like, I mean, like, why? And now, like, I understand, like, wow, like this really could happen. If I just shorted at $200 and I held 2,000 shares, I would be down like 4 million at the top, and I would blown up my shorting account. So it really opened my eyes to what could really happen. And now if I'm going to trade a liquid stocks, like I'll position myself with $100,000 in the stock. Like if you start pushing like a $300,000, $400,000, $500,000 position, that's when it gets really scary, because all it takes is 100% to lose multiple six figures. And for me, like I can take 30, 50, 70K losses. They still hurt, but that's like the most I'm willing to lose on something that's super extended and the liquid. And sometimes like they end up working, and I can make a few $100,000 if they start to sell off. But for me, it's just all about the position size. I really don't want to size in more than like $150,000 into it.
Yeah, I would encourage all our listeners to go check out the chart on HKD. It is quite shocking to see the movement that it made. Do you use leverage?
No, I mean, I will use leverage. I have different trading accounts. So like if I'm day trading something, I will never use leverage. But I've started trading like bigger cap stocks. Like I've made a couple of investments into this bear market, and I do use leverage on that trading account, but I'm never using more than like 1.2, 1.3 leverage, because I know those stocks aren't going to make a 50% move down against me without me having time to react to cut, because it'll prove itself over the long haul. Like, hey, this is breaking support levels. I got to get out. The market's looking bad, etc. Versus day trading, I will never ever use leverage, because how crazy the moves can happen and how unpredictable the moves can happen. And that's the only way I'm using leverage. And I'm not really even using leverage because I have my account spread out. So it's not like I'm betting like my entire net worth plus some, if that makes sense.
Uh-huh. So what conditions do you need to hold penny stocks for multiple days or weeks versus, say, just day trading them?
I would say that I need like seasonality, huge volume, seeing people make money. So one of my biggest indicators, I had a bunch of 1,000% winners back in December of 2020 into February of 2021, because I kept seeing all these Joe Schmoes making thousands of percent. And I'm like, how are these people making money? And I was like, at some point, you just have to realize like people who don't know a lot and people who are just buying into scams and they're going up. Like a lot of people would be like, hey, these guys are idiots. They don't deserve to be making money. I'm going to short this stuff. But sometimes like people like that they're smart for a very narrow window, right? But the problem is people never sell and it comes back in and they think it's going to be the next Apple. But if you just take advantage of that huge move up and you don't fall in love with the company, you can make money. So I started seeing a lot of people make money and I started seeing OTC stocks just running like crazy. So I started buying stocks that were in hot sectors, electric vehicles, Bitcoins, weeds, just low price stocks, trading huge volume with a big story, etc. And I bought a lot of those and I probably made 10 to 20, 500 to 1,000% winners. And some of them I sold way too early and I could have made like I was buying some stocks at like 0.006, 0.003, 0.009, 1 cent, 3 cents. And these stocks were going 10 cents, 20. The biggest winner in all of OTC, which had phenomenal liquidity, was TSNP. Now they merged the company and now it's HMBL. And it went from 0.002 to over $2. They also it will show that the high is like 7 or 8 now, because once they merged, they also did a reverse split or whatever, and the price went higher. But yeah, one of my friends had bought 50 million shares of it at 0.0001. And yeah, he put about $5,000 into it at nothing. And at the top, it would have been worth like $10 million or $100 million. Oh,
wow.
And he put like $5,000 into it, but it would have been impossible to sell all those shares up there, of course, because it was still trading good volume, maybe like 20, 30 million shares a day. But yeah, that's the possibility if something crazy happens and you get into a crazy market like that. And we saw a lot of those just go from dubs and trips to 50 cents, $1. So, wow. And now it's trading back at 2 cents though.
Oh, wow. Oh God.
Crazy.
So are you more emboldened to take on larger short positions in a penny stock or hold short positions longer because of the higher likelihood that whatever fake news or hype that caused these type of stocks to spike will reverse quickly?
There's a couple problems with shorting and holding. Like the number one thing being there's a very expensive short interest. Like if everybody knows that the scam, everybody's going to be shorting it, and the interest will be 500 to 1,000% to hold it overnight. So that just recently happened with the ticker GTII. It ran from, what was it, like 60 to 80 cents, topped at like 9 or 10 cents last month. And I was shorting it 7, 8, and it ended up cracking all the way down to like 2 or 3, but I just couldn't justify myself holding 20, 30,000 shares short and paying like $5,000, $7,000, $8,000 a night in overnight interest. So I had a good trade on it the day that it was volatile, and it just ended up going sideways for about a week. So you would have ended up paying like 30 or 40,000 just to hold it short, which would have ended up paying you money if you covered it at 2 from like 6. You would have made good money. But for me, the stress and also the uncertainty, hey, what if this isn't right and it starts going back up? I'm taking a loss, plus I'm taking a huge loss in overnight interest. So I really don't like swinging the penny stocks overnight that are scams. I just like day trading them when I like capturing the day that they're going to dump 20 to 50% and covering my shares that day. And then maybe the next day I short it again, small size, and try to capture another morning panic. But I don't like holding for more than a week or two personally.
Excuse the last interruption here. This is Tessa Farr. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
Yeah, I'd like to move towards talking about the mindset in trading. I'm curious to hear, how do you emotionally detach yourself from the amount of money that you're winning or losing and keep your cool?
I would say at the beginning, it was really hard because $1,000 here, $1,000 here, $500 there went a long way, and it still does. That's still really good money. But now I have large enough accounts where I don't really even notice like my account go up or down. Like at the beginning, I'd be like watching it slowly grow, like 200K, 300K, 500K, 700K, whatever, etc., and it keep going up. But now if I'm trading and my account has like 2.2 million or 2.3 million, it doesn't really like matter to me as much anymore. I don't really pay attention to it as much because I've seen so many numbers flicker in my life. So I guess you just kind of get numb to it.
Mm-hmm. Do you consider trading to be a sport?
Yeah, I would say it's definitely a sport. You're competing against, and usually the people that put in more work, like they're going to be more profitable, and they're going to outtrade you because they're working harder. So the more work you put in, it's the same with sports. If you're in the gym shooting free throws every single night, you're going to be able to make those free throws in the game versus someone who just doesn't practice.
Good point. What about personal care? When you're striving toward your trading goals, upon reflection, did you think you were making major health or relationship sacrifices?
Yeah, in 2019, 2018, when I was living in Michigan, I had no car. I had like one or two friends, and I would just sit in the office and just study and watch the market all day, every day. And the market was not very good back then. So it was just super depressing because I was working so hard and I was barely making any money. And I really had to fight for every dollar that I was making. Plus I had bills to pay. Plus I had to pay rent and stuff like that, groceries. So it was super depressing. And that was when I was really sad. And then ended up moving back home. And I had a car again and I had more friends. And I started getting more happy. And then the market turned on to, the market just started going crazy. And I knew I was working in 2019. So I used all that energy. And I feel like this is what kind of separated, is that they didn't work as hard because they didn't grind as hard and put themselves through depression to learn the market in 2019 and 2018, 2017. And I just wanted it so bad that I was willing to do anything and tell anyone to leave me alone. Like I'm focused, and I was so zoned in and so much tunnel vision. I ended up getting super sick in 2020, 2021. 2020, got COVID, traded through it. And then towards the end of the year was my worst sickness. I got mono and strep throat at the same time. And I was so beat up. But the market was so hot. This was in December of 2020. And I just continued to trade through it and ended up really just like putting myself into a habitual burnout where I had no energy for like 2 or 3 years. Like I was so sluggish. I was so irritable. But I knew like this is what had to be done to get where I wanted to be. And now this year, I've made sure like, hey, if the market's not good, I'm not going to sit here and trade all day. I've been traveling a ton this year. I get massages weekly. I make sure to get outside and go for a walk every day. I make sure to exercise. This was nothing I was doing. I was just sitting in front of the computer screens all day, every day, the last couple of years. And I had to reteach myself how to have fun, because when people were having fun the previous 3 years, I wouldn't even allow myself to have fun because I just wanted to focus on trading. And that's the only thing that mattered. And now I love having fun, and I re-taught myself how to have fun, and I've probably picked up like 30 to 50 hobbies this year, stuff that I used to love when I was a kid, and I just stopped liking them because I was so focused on trading. So it's been a nice shift, and this has been one of the better years of my life because now I have the freedom to do what I want, and I'm still making money in the market, and I'm not as stressed out.
Wow, that's great that you're learning how to get some balance between trading the markets and taking care of yourself. Have you developed, since processes are important when trading the market, have you explored developing processes for other areas of your life, like, diet, exercise?
Yeah, I definitely have. I would say like the main thing is I've really just been focused on like schedule driven this year. So I get up at a certain time. I do certain stuff throughout the day. I usually make a certain breakfast, and I get outside at a certain time. So every day that I'm home and it's a regular work day, I have a specific process. I'm doing my Excel work at a specific time, etc. And I think that's definitely have learned that type of discipline through trading. But when I go on vacation, I don't really follow a process. I just do what I can to experience the most that I can.
Uh-huh. What would you say to your fellow trader regarding mindset and personal care? Any tips?
I would say like the number one thing for me that I regret that I didn't do was I didn't stretch enough of my upper back, and I developed a lot of knots. And also I got a lot of sickness because I wasn't taking vitamin C and I wasn't seeing the sun. So my two top tips are to get outside every day and just make sure that if you are feeling stressed, just to use a massage gun or to stretch your upper back area a lot, because you really can develop nasty knots that don't go away and significantly decrease your life and happiness.
Great advice. My understanding is that your process and your discipline and strategies helped you turn just $10,000 into over $6 million in just 4 years. Has your lifestyle changed throughout your trading successes?
I turned about, I had 10,000, but then I kept working my valet job, and I ended up starting, and my mom also gave me my mutual fund too, supporting me. And I ended up starting with like 20 to 30K, kind of in between that range. And I've turned that now into almost 11 million in profits. But yeah, after taxes, I'm clear. I'm obviously not, I don't have 11 million. But that is how much I've made in my career.
Nice.
And yeah.
Nice. I mean, did you modify your lifestyle over that time period, or?
Meaning like, what have I done for myself?
Yeah. Like, I mean, some people imagine, well, as soon as I get my first million, I'm going to buy this or buy that, or, take a nice long vacation to some fancy place. Did you modify your lifestyle much?
Well, when I hit my $1 million mark, it was in November of 2020. And I couldn't enjoy myself because the market was so crazy that I had to stay focused. And the next month I ended up making 800,000, almost doubling what I had already made. And I was just so focused. And then the next month I made like $1.5 million, and the next month like 2.5 or something. And during that stretch, like I wasn't even realizing how much money I was making. I was just trading because there were so many opportunities, and I was just doing whatever I could. And at one point, like I couldn't even keep up with my Excel work or like tracking how much I was making or losing. And I was just trading. At one point I had like 70 to 100 positions on overnight every single night. And I couldn't even begin to think like, hey, I need to buy this or buy that. But it was only after I finished like that hot wave, and then I could say, hey, the market's slowing down. I tried really hard this month. I only made 100 grand compared to like my other few months. And then I started saying like, hey, what can I do now with this cash? So I ended up, one of the first things that I did was I withdrew 50,000 or 100,000 from the bank, and I gave my parents 50,000 each on my 23rd birthday, which was about a year and a half ago. And that was the first thing that I did. And then the second thing that I did was the next month after that, I bought a car. Nothing crazy. I got a Nissan 370Z, fun little summer car. And after that, I've bought a couple watches. Just I like them because they hold value and also take some cash out of your account and giving you some physical value. And other than that, that was really it. I bought my girlfriend some nice presents throughout the years. Really, the only other thing is I spent a lot on travel and experiencing stuff through this year and late last year. I've been to Italy, Greece. I have a trip coming up soon. I'm going to Norway, Sweden, and Denmark for a food tour. Going to be eating at the top 5 or 5 out of the 12 best restaurants in the world. With also I am eating at the top-rated restaurant in the world, and that's like an experience that I'm really excited about. Other than that, just learning photography and stuff like that.
Great. Yeah, that sounds like a fun adventure you're going to go on. That video that I saw of you going to the bank on your 23rd birthday, that was really impressive. I mean, withdrawing, all that money in cash and then, giving it to your mom and dad as thanks for being good, loving parents to you. I can't forget the expressions on your parents' faces. It was very moving.
Thank you, man.
Yeah. So in closing, what would you say to traders who are losing money?
First off, like this year's been very difficult, and I would say that the last couple of years, like it was relatively easy to make money, as long as you had some type of process. It didn't even have to be that disciplined because everything was just, there's so much volatility and volume, and now it's very difficult. And this type of year is the best to learn in because it's really going to teach you your discipline, and it's going to teach you a process. And if you don't follow that process and discipline, you're going to lose money consistently. But if you are disciplined, you'll be able to make small, consistent money, and just know that eventually a hot wave will come back around. And that's when you scale up, and that's really going to be the difference maker in your account. And if you are prepared and you have been working on your process this entire year, you're going to be able to do great things. So just have some patience and continue to work every day, even if it's demotivating. I know how it feels. I worked every single day for months and years without really turning a profit. But all it takes is 1 month really to grow your account 100, 200%. And then from there, if you keep compounding it, you'll be surprised by how exponential it could potentially go if you have the right process and you have the right market lineup.
Yeah, great advice, Jack. It was thanks for coming on Chat with Traders. It was great having you on the show.
Yeah, thanks for having me. It was really a pleasure to speak with you, Ian.
Yeah, how can our listeners get in touch with you?
I have my Twitter's Jackaroo_trades. My Instagram is just my first and last name, Jack Kellogg. Kellogg's Kellogg. A lot of people just put 1 G. Has 2 G's. Other than that, some of my trades are posted on Kinfo and Profitly, a couple of third-party verification softwares that I use. And that's about it.
Great. Thanks for sharing, Jack.
Thank you.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers open the doors. Mobile apps